I'm going to start this video differently than any other trading video that you've watched. My name is Chase Williams, also known as C Willie, and I am the founder of Mind Over Markets. I'm not going to show you a Lambo, I'm not going to show you a screenshot of a $100,000 day, and I'm not going to promise you that you're going to quit your job in 30 days. But what I am going to do for you is give you the most honest, step-by-step trading guide that exists on the internet right now, all for completely free in this video. Now, here's who I am, and I'm going to be completely honest with you because you can probably relate. I didn't come from money, I don't have a finance degree, and I never went to college. While most of my friends were at school, I was working a 9 to 5. I was watching the clock, wondering if that was going to be the rest of my life. I stumbled into trading the same way most of you did. I saw someone talking about it online, thought it was probably a scam, but I couldn't stop thinking about it, so I started learning on my own. No mentor, no course, just me, YouTube, and a lot of blown accounts. And it took me longer than it should have. I've made every mistake that you can possibly make. I chased trades, I revenge traded, I over traded, I overloaded my charts with all these bullshit indicators and still couldn't figure out why I was losing. And then something clicked. I finally stopped trying to predict the market. I stopped looking for the best strategy. I found one setup. One that had a real edge, and that was the orb strategy, the opening range breakout. 2 lines on the chart, no indicators, no guessing, just waiting for the market to show me where it wants to go, and then I simply follow it. And I trade this live every single day at 9:30 a.m. in front of all my students. I run multiple funded accounts across Apex, Alpha, and Lucid, and I've helped students go from knowing absolutely nothing about trading to getting their first payout in 60 to 90 days. This video is everything I wish I had when I first started trading. I built this course because I know what it's like to be where you are right now, watching video after video, more confused each time, wondering if you're even doing this right. And by the time we get through everything in this video, you're going to know what trading is and why it's not gambling when you have a system, how to read a chart from scratch, how to identify the structure of the market before you even think about entering, the exact orb strategy I use every single morning step by step, how to manage your risk so one bad trade can never hurt you, how to get access to $50,000 in trading capital without risking your own money, and how to practice so when you do go live, you're already confident. This is not a 10-minute overview, this is a full course. We're going to go deep. And if you're serious about this and you actually want to learn how to trade and not just consume content, this is the last video you'll need to watch before you start. So let's get into it. Now, before we get into strategy, we have to kill the biggest lie that keeps people from starting. Trading is gambling. You've probably heard that, maybe someone in your life has said that, or maybe you're thinking it yourself. Let me be direct. If you are trading without a system, yes, you are gambling. Complete random decisions, no defined risk, no edge. That's gambling, and 90% of people who are blowing their accounts are doing exactly that. But that's not what we're doing here. When I take a trade, here's what I know before I click the button. I know exactly where I'm entering. 2, I know exactly where my stop loss is and how much I'm risking. 3, I know exactly where my target is and how much money I'm going to make if I'm right. 4, I know that over the last 500 setups that I've taken, this specific setup wins 83% of the time when all the conditions are met. And that's not gambling, that's a business decision with a statistical edge. Here's how I think about it. A casino doesn't win because every hand of blackjack goes their way. They win because over millions of hands, the odds are in their favor. They lose individual hands all the time and they don't care because they know the math works out over a large sample. And that's how I think about trading. I don't need to win every single time. I just need my winners to be bigger than my losers, and I need my edge to hold up over a large sample of trades. If those 2 things are true, I make money, period. So now let me ask you something. Has anyone you know ever called trading gambling and left it there like it was the last word? Here's what they don't know, and it's not their fault. Most people who say trading is gambling either lost money trading the wrong way, or they've never actually studied what trading an edge looks like, because there's a big difference between a trader and a speculator. A speculator walks up to the chart, they see price going up, they enter a buy because it feels right, and then when price drops down, they end up panicking. That's a speculator, and that's closer to gambling. A trader has defined rules, a trader has a system, and a trader knows that one single loss means nothing, because they know that their edge plays out over hundreds of trades. And you're about to become a trader. Okay, so what exactly is the market? In the simplest terms, the stock market is a place where buyers and sellers come together to trade ownership in companies or financial instruments. Every single candle on your chart, every single green and red bar on your screen represents real people, real institutions, real banks and hedge funds and retail traders all fighting over price. A green candle, buyers won the battle, they push price higher. A red candle, the sellers won and they push price down. That's it. That's all a chart is, a record of who won each battle. And here's what matters for us. These battles don't just happen randomly. Buyers and sellers tend to show up at the same places over and over again, and patterns that played out before play out again. That's what we're learning to see. Not magic, not prediction, but pattern recognition developed over time. Now, let's clear all the confusion about what we're doing here. Investing is buying something and holding it for years. You buy Apple stock and hold it for a decade. Most normal people in a 401k are investing. Low effort, long-term horizon, and slow growth. Swing trading is holding trades for days to weeks. You identify a setup, you enter, and wait. You don't need to watch the market all day. Good for people who can't sit at a screen all morning. But day trading is what we're focused on, opening and closing trades within the same day. Usually within the same session, within a couple of hours, you're done before noon and you don't need to hold your trades overnight. Now, why day trading? Here's a few reasons. 1. No overnight risk when the market closes. You're not exposed to news events at 2 a.m. that crater the position you're holding. 2. The orb strategy is specifically designed for the first 1 to 2 hours of market open. This is where the biggest moves happen, and this is where all the liquidity is sitting. And this is where the edge is. 3. Prop firms, which we can get into later. You can trade with $50,000 to $200,000 in trading capital, starting with almost nothing out of pocket. That's a day trading opportunity, not an investing one. And one more thing right before we move on is why futures. When most people think of trading, they think stocks, Apple, Nvidia, Tesla. We trade futures, specifically the S&P 500 futures, also known as ES or MES, and sometimes the NASDAQ futures as well. Here's why. Futures contracts have what's called 60-40 tax treatment. 60% of your profits are taxed at long-term capital gains rates. No matter how long you held the trade, for active traders, this is a significant advantage over stocks. One ES contract controls about $250,000 in the S&P 500 exposure. So you can trade a significant size without needing a massive account. So we get more leverage. Now let's talk about the hours. Futures trade about 24 hours a day, but stocks, options, and equities shut down after 4 p.m. The orb strategy specifically targets the 9:30 a.m. open, which lines up perfectly with futures liquidity. And then we have the no PDT rule. Stock day traders need $25,000 to execute more than 3 trades in 5 days. That's the pattern day trader rule. Futures has none of those restrictions. You can trade as many times as you want regardless of the account. But we'll go deeper in the specific instruments later. For now, we trade ES futures for the orb strategy. That's our instrument. One of the biggest things that stopped me early on was thinking that I needed some sort of sophisticated setup to get started. I thought I needed some sort of Bloomberg terminal or a $10,000 custom PC build. I thought I needed to work at like a hedge fund or a bank to get access to the real markets. And all of that was completely wrong. And I'm going to show you everything that you actually need to get started. Okay, so the first thing we're going to do is we're going to open up Google and we're going to type in TradingView. Now, TradingView is a charting platform. It's where you're going to look at the market, find your levels, draw your orb, watch price, and enter your trades. And all you have to do is just press this button to get started, sign in, and it's probably going to take you to this page right here. The free version is fine, but I think to use the replay tool and to backtest, I think you do have to get the essential plan, which is about $13. And you can try it free for 30 days. And then you just press sign up. For me, I'm just going to sign in. And then once you sign in, if it's still on this page, you can just go to entire world. And then once you go here, just press this button right here, this little square button. Okay, or when you sign in, your markets are gonna look like this, like complete ass. You're probably thinking to yourself, what the fuck am I looking at? This shit looks like rocket science. It's not actually that complicated. I'm just gonna show you how to clean up your markets a little bit. You're probably gonna get some ads too since you're not paying for anything. This is my other account, that's just free version. And then you move your charts around and they go like this. And you know, a lot of people have troubles with that, but if you go to this bar and move it real quick, it'll unlock your screen to where it's not doing all that weird stuff. But yeah, let's make your charts cleaner, right? So me, I don't personally use this volume indicator. You can right click that, remove that. We're gonna right click this screen, right? We're gonna go to settings down here. We're going to go to trading. We're going to turn project order for market orders on. We're gonna use that later on in the video, so just make sure you have it on for now. And then we're going to go down to symbols. What we're going to do here is I'm going to change this to this green, and then I'm going to change the bodies to black. That's just how I personally like it. I like my bullish candles green and I like my bearish candles black. That's what we're doing here. I'm going to teach you more about that in a little bit. Our borders are going to be black just to help us see the candles a little bit better against the white screen. And then we're going to go down to canvas. right? We're going to turn off this watermark. We're going to go to grid lines. We're going to do none. And then let's see what else we need to learn. All that looks good, right? So now we can already see that the markets look a lot cleaner. We can look at this. We can read the markets just a little bit better, right? And then we need this toolbar, right? You want to enter your trades. You want to, you want to draw out trend lines. You want to mark your range, stuff like that, like this. So we need to get this box set up for you guys, right? So to do that, we have to go here to this little side section on the side. You're going to click this arrow, get the trend line. The trend line is basically just going to be where you can mark out your liquidity levels. That's what I use it for. We're going to go to this one and get the long and short position. So basically what this does, if you want to enter a long position, it just tells us how many points our stop loss is, how many points our take profit is, and what our risk to reward ratio is. So that's the long one. This is the short one. We want to favorite those two. Then we go down to this one and we want to favorite the brush. So favorite the brush, favorite the arrow, rectangle, and the path. The arrow, I just use this for when I'm like creating videos or trying to help students out, really. So you don't really need this one. But the brush, also don't really need this one. It's just I use this for videos. But this, I do mark my orb out with this. It does not look like this though. I keep it usually like that. Do this, do this, do this, and I usually have mine like this. So my boxes usually look like this, and then I will right click this, go to, or not right click it, but I'll click it, go to settings, and I'll turn my midline on. So that as well, and then yeah, and then this I just use it for my videos as well. So you don't really, so all you need is a trend line, long, short. You can use the path to determine if you're bullish or bearish if you're a beginner, and then the box. And I just showed you how to get those. So now on to the next one is the time frames that you need, right? So the time frames that I use the 4 hour and the 1 hour for my higher time frames, and along with the 15 minute. I don't really use the 30 minute. So you want to favorite the 4 hour, favorite the 1 hour, favorite the 15 minute, favorite the 5, 3, 2, and the 1 minute. And to do that, all you do is click this little arrow right here. It'll bring down this drop down, and you can favorite all of these, right? And then the second one, you want to make sure you guys are trading the right ticker, right? So to do that, go to the top left right here where it says SPX in my case, click it, and you want to type in MES. That is the ticker that I trade. That is the ticker that you guys should be trading too if you guys are using my strategy. MES, make sure you're on the right one though. MESM 2026. And the time of this video, this is the June 2026. So this contract will expire June 2026. So after that, we want to be using this one. So once this contract expires in June 2026, in June, we want to be using this one, and then so on and so forth. So yeah, because it goes by quarters, so the quarters of the year and stuff like that. So yeah, so we're going to be using this one, June 2026. And yeah, and then I'm going to show you guys how to connect a paper trading account, right? Because a lot of people, they want to practice live in the markets, but they don't want to use their own money. And this is how you're going to do that. You click on this top right section right here. It's going to be trade. And this is also how you connect your prop firm accounts too. If you want to trade directly through TradeAvate, you can connect your prop firm account to TradingView, and you can literally trade directly through TradingView the same way you can do paper trading. First, I'm going to show you paper trading, and then I'll show you how I log into my accounts through TradeAvate after this, right? So you want to click paper trading, and then all you're going to do is connect. It might ask you to sign in. Actually, no, it shouldn't, because it's not asking me anything, and this is a free account. I'm on the free version right now. So, and if I replay, let's see. Okay, you do have to pay for it if you replay. Maybe on the 1 hour. Let's see. Have to pay 4 hour. So you're probably gonna have to pay that $12.99 or however much it is. But yeah, so basically a paper trading account is you can trade without using your own money in live market conditions. Today is Sunday, so the market is closed right now. So you can't, markets aren't live, we can't really trade. But this is exactly how you would connect a paper trading account, and to enter a position, all you would do is you just click buy or sell, and you're entered inside of a position. In this case, we can't enter just because the price is not open right now. So, and then same thing for a Tradeovate account. If you are using a prop firm, I might show this to you again later on in the video. Okay, now I'm on my personal account, and I'm going to show you how I connect my broker, right? My prop firms. So I am funded through Apex, Alpha, and Lucid. So I have my three right here. I'm just gonna go through Apex right now. Okay, log in, and all you do is just type in all your credentials. You log in, shows your account, and yeah, this is how you literally just enter and exit straight through TradingView. Everything's connected, and yeah. Now, what is a broker? A broker is a company that actually executes your trades. Think of them as the middleman between you and the market. For futures trading, popular brokers include Tradeovate, like the one I just showed you, NinjaTrader, or built-in prop firm brokers. For most beginners using prop firms, it's usually going to be Tradeovate or their built-in system that most prop firms have, but you don't need to set one up separately. Usually all the prop firms handle that for you, but if you are trading live, then you would have to set that up for yourself, and I recommend Tradeovate myself. Now, this is the piece that most beginners don't know about, and when they find out, it changes everything. A proprietary trading firm, or prop firm, is a company that gives you access to their capital to trade. So instead of risking your own $50,000, you trade their $50,000. They take a small percentage of your profit and you keep the rest. But here's how it works in practice. You pay a small fee, usually around $50 to $200, to take what's called an evaluation. Now, the evaluation is a trading challenge. You have to hit a profit target while staying inside of certain risk rules. And if you pass, you get a funded account, which is real capital to trade with. Then you trade. When you make money, you keep 80 to 90% of the profits, and the firm keeps about 10 to 20%. Now, let that sink in. For around $70, you can get access to $50,000. And no, you cannot pass the account and just pull out the straight $50,000. You only keep the profit that you make on the account. So if you make $5,000 in that funded account, depending on which prop firm you go with, you're making about $4,000 to $4,500. So you don't need $50,000, you just need $70 and a proven strategy. This is the most accessible path to serious income through trading that has ever existed. And this is the reason why I tell every student to skip day trading with their own $1,000 and just learn the strategy, pass an eval, and then start making money from $70 instead of risking your own $1,000 and possibly losing it. So the prop firms that I recommend are going to be Lucid Trading. This is a really good firm. They just came out. I personally love them. You get a 40% discount if you use code CWilly. I also really like Apex Trader Funding. I personally use them as well. And you can get a 90% discount right now, at least at the time of recording this video, using code CWilly. And for this one, I recommend the EOD Trail. Tradeovate 50K is usually what I recommend, or you can do 25K, but I recommend EOD Trail and Tradeovate. And then for Lucid, I recommend the Lucid Pro. I usually get the 50K account, and you can get 40% off, like I said, with code CWilly. And then for the last one that I recommend, I like Alpha Futures. They are a really good firm. I've never had any problems with them. You can get a 25% discount with them. For 50K, I recommend the zero plan, and the 50K, you can, pass it in as little as 1 day, and you can get a payout every 5 winning days. So you can get a payout every week. So they're pretty nice. I really like this account. This is probably, if I had to pick a favorite, it's between Lucid and Alpha. But I think I'm gonna go with Lucid just because their consistency rule is better. Alpha Zero has a 40%, but Lucid has a 50%. And all that means really is just that one trade cannot be more than 40% of your profit. And so if it's 50%, it gives you a little bit more breathing room on that consistency rule. So that's why I like Lucid a little bit better. And yeah, and they also do give a bigger discount. So I would probably go with Lucid. And yeah, code CWilly, like I said, I think 10 to 25%. Okay, now that I'm on my account, before you go the prop firm route, before you do anything, if you're a complete beginner, we need to learn how to paper trade. And like I said, just go in here. We're in replay trading right now, so this is when this is how you backtest, not really paper trade. Paper trading is going to be trading in live markets, but this is how you backtest. So once you buy it, you can click replay and just go to that 9:30 candle, go to 9 o'clock, and then wait for that open. Right now, I'm just going to show you the basics. I'm not really going to go over strategy that much because I go way more into that later in the video. So now This is just where we can, mark our range. We can do all that stuff just in previous markets. So say this is what? This is Friday, April 10th, right? We are, far away from that right now. So we can, come over here in the past and just see how the strategy actually plays out every single day, and just go ahead and just go back test every single day in the past, right? And until you can, get confidence in it, right? So we go down, you determine your buys, market levels, do all that. You can, find your break wherever we get a break to the downside. Okay, we have a break to the downside. Okay. Right now, you probably don't know what I'm talking about. I'm just trying to show you the basics. Enter off of rejection. So all you would do, like I said, was just enter a sell. You can put that long and that short position right here. Just drag, you just click it and then click right here. And then you can drag your stop loss. And it tells you exactly how much money you're risking, and then grab your take profit. So yeah, that's how you do it. You can enter trades, do all that. So once you get that paper trading account, I want you to practice trading the orb every single money. Mark out your orb, find that breakout, find your bias, mark those key levels. I'm gonna teach you all that in the next coming chapters, but I want you to I'm just teaching you how to actually set up your paper trading account, right? So this is a replay trading, but what I showed you before, clicking the trade and then going to paper trading and then actually trading in the live markets every single morning. Mark out your lower orb, find all that type of stuff, and then actually enter your trade. So everything's going to be actually real and executed. Only thing that's fake is just the money that you're using, but it just shows you how you would actually execute in the live markets. And I want you to trade it exactly like it's real money though, because the habits that you build in paper trading are the habits that you're going to have in live trading. The rule I give every student is make sure you're profitable for at least 1 month. I say about 3, until you think about buying any prop firms or any evaluations. You should be able to look at your paper trading journal and say, looking at these 50 trades, I am profitable. My win rate is solid and I understand every single trade I took. If you can say that, then you're ready to go live. We know how to open the charts, we know how to look at the charts, but we don't know how to read the charts. When I first opened a trading chart, I had no clue what I was looking at. Red and green bars, lines everywhere, numbers scrolling. It felt like I opened a second language and had no dictionary. But here's the thing nobody told me, it's actually not that complicated. People add layers and layers of indicators and tools because they're looking for certainty. And certainty doesn't exist in the markets. So they keep adding things hoping that the next indicator is the one that makes it all make sense. And it never does. Now let me show you how to read the charts the right way, the way it actually looks when price is trying to tell you something. So right now you guys see the chart right here, and I know it probably just looks like a whole bunch of gibberish and you have no idea what's going on. Everything on a chart is made up of candlesticks, and each candle represents a specific time period. So on a 5-minute chart, one candle equals 5 minutes of price action. And on a 1-hour chart, one candle equals 1 hour of price action. And each candle is going to have 4 pieces of information. We have the open of the candle. This is going to be where price started at the beginning of that time period. And then we have the close. This is going to be where price ended at the end of that time period. And then we have the high. This is going to be the highest point price reached in that time period. And then we have the low. This is going to be the lowest price reached during that time period. So this is how it's going to look for a bullish candle. We have the open at the bottom and the close at the top. But for a bearish candle, we have an open at the top and a close at the bottom. So if I look here, we see price opens here. Since it's a green candle, price opened here, and it opened here because this is where price ended. And at the end of this 5 minutes, it closed up here, but you can see this wick just shows where price has been. So this wick is showing that it was at a certain point of time, it reached this high. And then after that 5 minutes is over, this candlestick opened right here, and then it closed right here. But in that 5 minutes, price reached all the way down here. And it was also up here at one point as well. And if we keep going down, we opened right here, closed right here, price was here at one point. We opened right here, price closed right here, we were here at one point. And later on in this video, these wicks are actually really important when it comes to looking at price action. And they tell you a story, but we're going to get into that a little bit later. And all these candlesticks are just a battle of buyers and sellers. So we see we have a green candle right here. We see that price closed higher than where it opened. So in this 5 minutes, the buyers won. But if you look right here, this candle closed lower than where it opened. So as you guys can see, this sellers won. So the body of the candle is the space between the open and close, and the lines above and below are called the wicks, and they just show you how far price reached before it pulled back. So a candle with a long upper wick tells you that price reached all the way up here and then the sellers pushed it down. And that's what we call a rejection. The sellers were waiting at that high and then they pushed them down. And then a candle with a long lower wick tells you that price reached all the way down here and then the buyers came in and pushed price up. So the size and shape of each candle tells us a story, and we need to learn how to read that story. And this is a book that I highly recommend you reading because it really breaks down all the candlesticks for you. It's a book I read when I first started trading and it really helped me a lot. So it basically just breaks down the history of candlesticks. It breaks down the psychology of them and why they work, and different candlestick patterns and candlestick formations that tell us a story and give us certain indications where price is going to go. So here's the mental model I want to show you every time you look at a chart. Every single candlestick is a battle between buyers and sellers. A green candle means the buyers won, and a red candle or a black candle in this scenario means that the sellers won. A series of green candles, the buyers are winning and price is trending up. A series of red candles, the sellers keep winning and price is trending down. So when we see big candles like this or like this, that means that one side is dominating. And there's conviction behind the moves, and that means that either buyers or sellers are really active in that area. And when we get small candles like these, neither side is winning and price is just chopping and having uncertainty. When you look at a chart like this, you're not just looking at random lines. You're watching a real-time war between buyers and sellers, and you're learning to read who's winning. So right here, you can see that we have two big green candles. So you can see that the buyers are coming in hard. Then a small red seller tries to push it back, and it didn't have enough force, and then we have a big green one again. So obviously this tells me that the buyers are in control. So you don't need an indicator to tell you what price is doing. Price is telling you what price is doing. Okay, support and resistance. This is going to be the most important concept in your trading. Support is a level where buyers have historically come in and stopped price from going lower. Think of it as a floor. Every single time the buyers come to that level, they show up and push it back up. And resistance is a price level where sellers have historically come in and stopped price from going any higher. Now think of that as a ceiling. Every single time price comes to that level, sellers show up and push it back down. Now, why do these levels matter? Because the banks, institutions, hedge funds, the big money, they all have orders sitting at these levels. When price comes back to these support levels, that's where institutional buyers have been waiting to buy. When it comes back to a resistance, that's where institutional sellers are waiting to sell. So we're not trading against the big money, we're trading alongside it. Okay, now we're on to time frames. The same chart looks completely different depending on what time frame you're on. The 1 minute chart looks like a war zone. Price is moving violently in all directions. The 1 hour chart is going to be a lot cleaner, a lot smoother. It's going to have a clear trend and clean levels. The higher time frame tells you the story. The lower time frame tells you when to act. The structure of the market, the overall trend, the major levels, the big picture exists on the higher time frame. And that's going to be the 4 hour, the 1 hour, and the 15 minute. The entry, the exact moment you enter into the market, happens on the lower time frames. And that's going to be the 1 minute. So this is my process every single morning. So if I drop down to the 1 hour, I see that price had just created a shift of structure. We had a big move to the upside and price needs a correction, right? So if I look to the 4 hour, I see that we also have a big push upside, price needs a correction. I'm going to teach you correction, shift of structure, market structure in a little bit here, but I'm just going to show you how I break everything down. And then I go on the 15 minute. I see that we're also having a shift of structure here. So I can be looking for sales here. And then I'm just going to mark out all my liquidity. Liquidity is something I'm about to teach you guys in a little bit as well. Okay, I have my session low and session high, something I also have to teach you guys. And we're just looking for sales here. We marked the orb. I'm not really going to go much into strategy here. I'm just going to show you what happens here. So we have the break to the downside, boom, and then price goes to the downside. Sweeps this liquidity. That's what we would be targeting for today. Here's one of the most important truths in trading, and I really need you to let this land. The market is not random. I know it feels random when you're staring at a 1 minute chart, watching price whip up, whip down. It just looks like pure chaos. But zoom out, go to the 4 hour, 1 hour, 15 minute, and patterns emerge that are clear, consistent, and repeatable. The market moves in structure, and once you can read that structure, you can trade with the market and not against it. So what is market structure? Market structure is a sequence of highs and lows that the market creates over time. In an uptrend, price makes what's called higher highs and then some higher lows. So a higher high is just when each peak is higher than the last. As you can see, we had this peak right here, then price came up, we broke it again, and then we broke it again. And a higher low just means that each pullback stops higher than the last. And in a downtrend, we have lower lows and lower highs. And a downtrend is when price makes lower highs and lower lows. And a lower low is just going to be when each drop goes lower than the last. And a lower high is just when each rally stops lower than the last. It's not that complicated. We're just looking for a staircase pattern. And obviously the market's not going to look this clean all the time. But an uptrend, the staircase is going up and we buy. A downtrend, the staircase is going down and we sell. And in a bullish market, we can only have a higher high and a higher low. And in a bearish market, we can only have a lower low and a lower high. So we cannot be bullish and have a lower low or a lower high, or bearish and have a higher high and a higher low. That is impossible. And we also cannot have a new higher low without creating a new higher high. So when price is making lower highs and lower lows, I can take a breakout to the downside because the market is helping me and I'm aligned with the institutional flow. And now if price had a break to the upside from here and I try to take buys, I'm fighting the trend and I'm going against the big money. And this is a trade that has a much lower probability of working. So we always want to form a bias before the market opens so we can see where price is most probable to go. And if it goes against our bias, we can probably either de-risk or just not trade for the day. Now I'm going to show you what a breakup structure is, what it means, what it looks like, and how to find it. So here's where it gets interesting. In an uptrend, price is making higher highs and higher lows, higher highs and higher lows, and a higher high. But at some point, price drops below that last higher low. And that's what we call a break of structure. And this is going to be our first sign that the trend might be ending. But a break of structure doesn't mean that the trend is over, it just means that the market is questioning itself. You need to see a follow through with multiple lower lows and lower highs to really confidently say that the structure has changed. And another rule when we're in a bullish market is that we cannot create a higher low or a lower high without creating a new higher high or higher low. And to create a new higher high, we have to break above the previous higher high. So if price does not break this higher high right here, then this higher high is never created, and this is just what we call market structure. And this higher low is never created. We're just stuck in this range between this higher high and this higher low. So now where most traders get wrong, they think that we are having a shift of structure right now and that price is bearish. But since price has never closed above this higher high or closed below this higher low, we are still bullish and the trend has never changed, and this is all just market structure. So in this scenario, if we close above this higher high, then the market structure has shifted, not shifted, but we have created a new higher high, and now we have a new higher low since we created a new higher high. But say the market did something like this, we did this, we broke below this higher low, now this market is bearish, with this now being a lower low, and this is now going to be our lower high. Oh Chase, why is this the lower high and why is this not the lower high? This is the lower high because we're going to use that most previous structure point, our most previous elbow, when we're looking for that higher low or lower high. So I know that was probably a little bit confusing to you. So let me break it down into more detail. So we are creating higher highs and higher lows. Boom, boom. So now we're right here. We are in between this higher low right here and in between this higher high. So what we're doing right here, where we're at right now, this is not a higher low. This is nothing. We are just market structure in between these two highs, waiting for price to show us where it wants to go. So if we do this, boom, this now is created a new higher high, and this is a new higher low. So now say we do something like this and we close below this higher low, that is what we call a structure shift. So you're probably gonna have to watch this video or watch this little part a couple of times just to really get into your head. But that is when we shifted structure because we broke this higher low. So now this turns into a lower low and a lower high because I said a bearish market is impossible to have higher highs and higher lows. So this is now a lower low and a lower high. This is that most previous elbow from that lower high or that lower low, sorry. So this becomes our lower high. So then we do something like this. Price goes up and then it breaks this lower low. Right now, this is nothing. We are just in between this lower high and lower low. But now we break this lower low. This becomes our new lower low. And then this is now our lower high because this is the most previous elbow. Say it did something like this. This would be our new lower low since we closed below this lower low. And this would be our new lower high. But in the market conditions, like on a real market, you probably would just see this as a straight line. So then that's when we just keep it as the same lower high. Because if we do not create a clean elbow or anything like that, then this is not like a good structure point for it to be counted. and this would just be all one lower high. Okay, but I'm going to go into the markets and actually show you what I mean when we look at market structure. Okay, so I'm going to go down to the 15 minute right now, and I'm just going to mark out our lower lows and lower highs and higher lows, stuff like that. This is how we're going to mark out market structure. I'm going to make it a little bit more simpler for you in a little bit so you can understand why I'm marking it like this. Boom, 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 boom. So this is the market structure, right? So we have the price came all the way up here. This is that higher high. This is when prices just moved all the way up. This is the highest point price moved before moving down here. So we have our higher high, price moved up, and then we have our potential higher low. That's why I don't want to say a higher low yet until we close above this higher high. So once we closed above this higher high, this became our new higher low. So now we have a higher high and a higher low right here. So we have a potential higher low, price closed above this higher high. This becomes our new higher low. We close above the higher high. Okay, then we close above this higher high. This becomes our new higher low. And then right here, as you can see, price went below that previous higher low. So this is what you would call a structure shift or a break of structure. But it doesn't always mean that it's going to be a reversal in the trend. What I'm about to teach you next is what we call liquidity sweep. It's basically when we sweep a level of liquidity and then we can just have a reversal from there. Yeah, then we broke above this higher high again, creating this as our new higher low. And then price broke under that higher low. And then now we're creating a lower low and then a lower high. Price created another lower high and then another lower low. So then this is when you can confidently say that we're in a bearish market, right? So this is a real shift of structure now. Now we can say that we're bearish. We are creating multiple higher highs and higher lows. And now we have switched to lower lows and lower highs. Boom, boom. So this is going to be our range from this low to this high. We can see we came here, price swept this liquidity, and we shot back down. And then we coming up here, we're shooting down. And then we got over here to when prices just shot all the way up from here. So boom. Okay. So why did I mark this? Like why am I marking these points, right? If you look at the market, let's take these off, right? Let's go on the line chart. It might be a little bit easier to look at it. If we go on the market, right, we can see that this is the highest. Prices went boom, high. We have a low. We broke that high. This was the highest point that we broke that high. And then this is the lowest point that high has been once we broke it again. So we broke it and then we broke it again. We got a high, 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 high. And then we have a low. Higher high, higher high, higher high, higher high. What is it? It's literally in the name. We have a higher high, a higher high, a higher high, and a higher high. We have a low, a higher low, a higher low, and a higher low. It's simple. And then we have a little break of structure right here, but it didn't last long. We create a new higher high. So in this scenario, we can obviously see that the market is just trending to the upside, right? And then over here, we just have a lot of choppy price action. It's not really good for teaching, and then if I turn these back onto the candles, you can see every single place that I've marked that's the higher high, right? So we just want to mark the higher high and then the higher low, vice versa. So I'm starting from here. There's no specific reason, but I start here and then I'm just going to that highest point, high. Then I'm going to that lowest point, low. Going to the highest point again, where price does not create any structure. This is almost kind of like structure. It's not that clean enough though. Like boom, boom. That's not that clean though. So I'm not marking it, but let's see. So we have a high, we have a low, we have a high, we have a low, we have a high, we have a low. This is how you should be marking it. Just marking out all your highs and lows. So the highest that price went before it started pulling back like this. And then you see these little peaks, right? I call them elbows. They look kind of like elbows, right? Like your elbow, like you're going like this, right? So these are going to be your little peaks, your little elbows, right? And then this is kind of how we see the market, right? It's kind of, I don't know. It's kind of, it's not confusing once you get it, but like once you understand what I'm trying to say, like it'll click in your head, right? So we have this high, we broke above this high, we have this low, we have this high, we have this low, we have this high, we have this low. And then once you're able to mark out this, you just drag it out. Okay, you drag it out like this. And now you tell yourself, where is the market going, right? You see that the market is obviously trending up. We create this little head and shoulders pattern, break structure, we pull back, and then we break this lower low. So now we can see that the market has obviously shifted bearish, right? So this is how you're going to be able to determine the trend as a beginner. You're going to come to the market, right? I'm going to start right here. In this scenario, this is kind of a bad scenario, but high, low, high, low, high, low, high, low, high, low, and then this is just market structure. You drag it out. This looks very choppy. Obviously, this is what the market is going to be sometimes. I mean, Trump is he's controlling the markets right now. So boom, we have this high, we have this low, we have this high. So higher high, we're making higher highs right here at least. And then we have this higher low. We break all of this. So now we have a lower low and a lower high. We're not breaking this high. Okay, we're not breaking this high or this low. So we're just staying in this range. So technically all this shit is just market structure. It's not a clear trend. It's just consolidating. We don't know where the market is trending, right? It's not in any certain trend. But it technically is all bullish. If you have to call a trend, it is going to be bullish, with this being our lower low, our higher low, and this being our higher high, just because it has not broken this higher high or this higher low. So this is our little range. Okay, now I found a good trend for you guys. So now let's look here. We have this right here. Okay, we're moving, we break this low. So now we can say we're lower lows and lower highs right here. So we have this lower low, we have this lower high. Boom, we sweep it, liquidity sweep, and then price just pushes down. I'm going to teach you guys liquidity sweep in the next chapter, so just give me 1 second. Okay, lower low, lower high, lower low, lower high. Well, not lower high, but lower low, high. So now we swept all of this, and price continues to go down from here. We have this low, this high, this low. Price goes all the way up here. Okay, then we go down here, we go up here. And then we can just keep on marking it, right? Boom. Okay. So if we look here, we can obviously see that price is trending to the downside, right? We are making lower lows, lower highs, lower lows, and lower highs. We have this big move to the upside, but it's not really a shift of structure yet until we start creating higher highs and higher lows. Then that's when we can say that the trend has really shifted. But we still continue to go down, here. And then, chop, and then we go down and down and down. So this is what a trending market is going to look like. In this scenario, we should be looking for sells here. We have the orb, we mark it, look for a retest, and then sell. This should give us a lot of confirmation in our trade. Okay, let's practice some more. We have this right here. We have this low, high. We have a low, high, low, high, low, high, low, boom, boom. Boom, 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 boom. So this is what this price action is looking like right now. If I drag this up, this is how price is moving, and this is how we look at it. This is how I see it when I look at the market. I can instantly just see, boom, I know where the market is trending. I know for higher highs, higher lows. I know where our most previous higher high and higher low is, or lower low and lower high. And this is how you just need to do it. So you just practice calling out higher highs and higher lows. Practice just going to the market and circling higher, like high, high, high. Just circle all your highs, and then you can say this would be a high. And then we have this high, 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 and then count all your lows. We have this low, 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 low. Then connect them, right? Connect them. Low, high, low, high, low, high, low, high, low, high. We kind of have a lower here too. High, low, high, low, high. Just connect them. So circle all your lows and highs, where price is going. Circle them, then connect them. That's going to be the easiest way that I can probably tell you to learn how to read this market structure, right? And then once you do that, once you have that, boom, drag it out, and then now mark them. Say, what is it? A lower low and lower high? higher high and higher low. In this scenario, we're creating higher highs and higher lows. So this is a higher high, higher low. We broke above this higher high, creating this, making this our new higher high, and then this our new higher low. We broke below this higher low right here, shifting us bearish, making this our lower low. This is our most previous elbow, so this makes this our lower high. We do not break above or below until we get here. So then that means that this is our lower low. And then now where do we put our lower high, Chase? At the most previous elbow. So where's that most previous elbow going to be? What I like to do is something called the snake trick, right? So the snake is always moving like this, right? That first turn that the snake makes, that's going to be our higher low or lower high. And if we do that right here, right? So price is going. If you do this, you can see that the snake made its first turn right here. So that means that this is our lower high. That's how we calculate that. Price did not break above or below until here. So this is our new lower low. Let's do our snake trick. Price made its first turn right here. This is our lower high. We broke above, shifting us bullish now. Higher high, higher low, and then finally we broke below. This is now our lower low. We pull out our snake trick. This is where the snake first turned. Boom, lower high. That is how I want you guys to do it. High, high, low, low, low. Connect them, drag it out, then find out your highs and lows. And that is going to be how you guys can read market structure. So if our higher time frames are in an uptrend, then we want to be looking for longs. And if our higher time frames are in a downtrend, then we want to be looking for sells. Or if structure is choppy and unclear, then we either want to size down or just sit out completely. Most professional traders I know are only trading 2 to 3 clear, obvious trade setups a week. Not every day, not every condition. They're waiting for the market to perfectly line up with their edge, and then they act with conviction. Okay, now building your bias before the market open. Every day before 9:30, I do the same thing, and that's going to be building my bias. I open the 4-hour chart. Is market an uptrend, a downtrend? Are we consolidating? What are we doing? Then I go down to the 1-hour chart and I do the exact same thing. And then after that, I go down to the 15-minute and I'm doing the same thing, but then this is also where I mark out my key levels of liquidity, my previous session highs and lows, and things like that. And then I make a decision. Am I bullish? Am I bearish? Am I neutral? And that's going to be your bias for the day, and you're only going to trade the orb in that direction. So if I have a break to the opposite side of my bias, I can anticipate for it to either be a fake breakout or I was just wrong about my bias. And sometimes if I think I'm wrong about my bias, I'll either just size down or I'll just sit out. And it sounds simple because it is. But doing it consistently every single day before the market opens is what separates traders who have a system from traders who are just reacting to what the market is doing. Now let me actually show you guys what this actually looks on the chart. So if I go down to the 4-hour, I see that price is pushing down and going up. We got a low, we got a high, we got this low, and we are at this high now. So if I look, I see that we are going downwards, and I see that price has shifted and we broke above this lower high, making us technically bullish, but the trend is not changed yet because we have not created a new higher high. So we're not creating new higher highs and higher lows. So we're safe to say that the price has shifted bullish, but the trend is still the same. I can see that we are having these lower lows, lower highs, lower lows, lower highs. We shift structure, and then we can see that we get choppy, not really creating any higher highs and higher lows. So we were bearish, we were bullish here actually, and then we're still creating lower lows, lower highs. Price right here is just indecisive. This is what we call a choppy market. There's no trend right here, no trend going on. And then if I drop down to the 15-minute right here, I can see, yeah, we're just choppy inside of this range, and price is just being choppy. But what I do see, and what I'm about to teach you guys in a little bit, is that we are sweeping a lot of liquidity, sweeping this liquidity right here. And then we have the rejection candle, what I told you guys about earlier. As you guys can see, the buyers were all the way up here in this 15 minutes. And then the sellers came in once we swept this liquidity and pushed them all the way down here. And then that's where we closed. That is a big form of rejection, right? So my bias here is bearish, just because the overall trend of the market on the 4-hour is kind of bearish. We are sweeping some liquidity right here. Price is rejecting that liquidity, and we have a lot of bearish pressure right here pre-market open. Okay, so I'm going to mark this 15-minute candle, and then I'm going to mark all my liquidity out. Actually, before we do any of that, mark all of this out, mark this, and I would usually mark all of these levels out, but just for this video, I'm just going to mark these ones out for now. Okay, so I want to be targeting these lows. What I'm about to teach you guys in a little bit, market is always moving towards liquidity. So if you have a lot of liquidity down here that market needs to take out, then that's also another confluence that we can add to our trade. So boom, we can see that the market is trending down right now. Okay, we have a downtrend, price broke the orb to the downside, and then we have the big push out, right? So you could have entered right there. And then we retest some liquidity, and then this is a point where we can be looking for buys. You can also, probably enter your trade right here off of this rejection of liquidity. We can see that price hit this liquidity, and then the buyers instantly stepped up, right? So if you look closely, there is no wick right here. So the sellers did not come in to this market at all. There's no wick, no sellers, right? So that means that there's a lot of buying pressure here. That means that the buyers are just sitting at this level and waiting for price to just get pushed up, right? So that's an indication. If you know that, and you know how to read a candlestick, that's why that Candlestick Bible that I taught you guys to read is going to be very important. You guys can see that and be like, okay, the buyers are stepping in once we're hitting this key level. There's 3 key levels right here that we're hitting. A lot of buyers are stepping up into the market. We can anticipate for us to get a retracement back into the orb like we do. And I actually took this trade live with all my students, and boom. So we took this trade live, and then boom. So we're retesting the orb, right? So this is the break, and then this is the retest. This is the trade that we're really waiting for. Price is hitting the area, right? And now we're having some rejection. We have this engulfing candlestick, right? So the buyers came in, and then once we hit it, the sellers start coming into the market, right? We have the buyers were all the way up here. The sellers pushed them all the way down, engulfing these last 2 candles right here. And then if we keep going, okay, we're having some good selling pressure from this area. Okay, buyers come back in, and then the sellers push them out again. Okay, now I'm starting to see some rejection. I'm starting to be interested. Okay, wait, buyers come in. Okay, sellers are fighting, and they push them down. Sellers push them down again. So now at this point, I just want to wait for another break outside of the orb. Okay, so the sellers are pushing them down. They're doing their job, right? I can see that price is holding this level. Boom, you can enter right here. Put your stop loss somewhere right there, and then just target this new low, right? Then let's see what happens. Boom, we absolutely smashed that area, right? So boom, that is how we create a bias. I'm going to go more in depth about the strategy and the key levels, the orb, and how the strategy works. That is just how we find our bias, and that is just it playing out. Now we're on chapter 5, key levels. Let me tell you something that changed the way I see the markets. The same levels that matter to you matter to every institution on Wall Street. All those previous highs, those previous lows, every major hedge fund that trades ES has that level on their chart. Why? Because those levels represent places where the market has made decisions. A place where buyers previously overwhelmed sellers or sellers overwhelmed buyers. And the market has a memory, and it comes back to those places to test them again. We're not competing against the big money on these levels, we're joining them. Now, here's exactly how I mark out my key levels before each session. The first thing we're going to do is just mark out the highs. Like we have highs, mark out all of our highs, right? So this is going to make it a lot easier for you. We see that we have all of our highs. Now we want to see which highs are not swept. And as you can see, if we look at this high, we see that we swept it here. We swept it here, and obviously if we swept this one, it's higher than all these ones. That means it's swept. And what I mean by swept is when price has come back and tagged over it. Like as you can see, this area is not swept. Get this. This area is not swept because price has not came up here and touched it, right? So it's called an untested or untested high, untested low. That's what we're looking for in pre-market, or when market opens, we want to mark out all of our untested highs and untested lows. So this is going to be the high. So we have one high right here that is untested. If you look back over here, you don't really want to go back too far. You want to stay in the session. in like probably this last New York session, right? And if you really have nothing, then maybe you can go back a little bit if there's like nothing. So then we have a low right here. That price is not swept yet, but I probably wouldn't mark this. This is what I would mark, this previous session low, because this is the lowest point that prices went in London without being swept. This low in New York from last New York, yesterday's New York session. This is that low. So we have London low, and we have a New York low right here. And then we have a London high, right? So then now we're in New York session. We can be targeting the London low and the New York low, right? We see that we swept New York high. We can be targeting the New York low. But we still have to, determine the bias and all that type of stuff. But I'm just teaching you how to mark your highs and lows. So let's go back to this day, right? Yesterday, let's mark out all of our lows. We have a low, 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 lows, all these. Now, which ones are unswept, right? So I can see that this low is unswept. Price has not swept this area right here. If I see right here, price has swept this area. So you can see we tapped it twice, swept the area. So that is not valid. We have this low right here. So it would be our London low. And then we have the New York high right here. Mark out all of our highs. Sorry, let's do that first. So we have high, 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 all these highs right here, right? So this one is unswept, and I wouldn't count that as a high. So this is our highs and lows. We have New York high, and then we kind of have an Asia New York high right here. And then we have our London low, and then New York low right here. So these will be our levels for today. And then we determine our bias, and then wherever our bias is, these would be our target levels to put our take profit at one of these, the closest one. And see, the price is always moving towards liquidity. So this is basically liquidity. What I just showed you right now is how to mark your liquidity. Liquidity is just basically where everybody has their stop losses at. And every retail trader has their stop losses at these previous highs and lows. Okay, now we have another example. This is how we're going to mark out our liquidity. We have our high, we have a low right here. We see that there's another low right here, but we can see that price has swept this low. We have highs right here, but we see that we have swept those highs. So this is our high and our low. This is our liquidity that price is price is going to take out for the day unless we're choppy and ranging. But the market is always looking out to sweep liquidity. It's moving from liquidity to liquidity. So this is what we call external liquidity. It's just going to be where people have their stop losses at. And then what I'm also going to teach you guys is internal liquidity, is stuff like fair value gaps. So I know you guys probably hear this term fair value gap a lot, and I'm going to break it down very simply to where you can understand it. So a fair value gap is when we have a series of 3 candles, whether that be up or whether that be down. In this scenario, these are 3 red candles going down, right? So we see the wick. We have a wick right here, and we have a wick right here. And as you can see, these wicks are not overlapping, right? Leaving this gap in the market, right? So this is an internal liquidity, right? So when price reaches this area, this is also an area that the market is going to be targeting to fill this gap. And then we might either have a reversal, or not a reversal, a continuation, or a reversal if we inverse it. And an inverse is just going to be if the body of the candlestick closes above. So if we got something like this, the body of the candlestick didn't close below or above, and we got something like this, this would not be an inverse because we are still inside the fair value gap and the body is not closed. So once the body closes like this, then that's when we have inverse fair value gap, and we should no longer be looking for shorts. Sales, shorts equals looking for the market to go down. Long equals for we're looking for the market to go up, right? So if we see this, we see that we're in this fair value gap. We can expect for price to come down now and then continue selling. So we created this fair value gap, price comes back, taps into it, rejects it, and then we can take a trade to the downside. So now if we go down to the charts, we can see that we have a lot of fair value gaps, but not every fair value gap matters. So you see that we have one right here, we have all these fair value gaps. You can see that we inverse this one because price came back to it, and we obviously just rejected it and closed below it. And then we came back, retested that fair value gap, and now we are rejecting it, right? So we can now say we shifted structure. We're disrespecting bullish fair value gaps and bullish structure. So we can confidently say that we could probably be looking for sales to either reach this liquidity. And as you can see, we do reach this liquidity. And from here, it would not be a bad idea to buy the market if we inversed this fair value gap after sweeping this liquidity. But as you can see, we did not inverse it and we respected it, right? So we pulled back to the fair value gap, just like I said, literally perfect. I didn't even try to do that, but we pulled back to this liquidity, internal liquidity, fair value gap. We rejected it. We did not close above it. We respected it, and price continues to push down, right? We have another fair value gap right here. We are bearish. If we respect it, and see, look, we inverse the fair value gap, and as you can see, we have a big push to the upside. But you don't want to just enter off of every inverse and every fair value gap. You want to make sure you're doing it because of because of all the confluences that we have together. So, if we have an orb and, we break to the downside in that orb, then price pulls back into that orb and we're also inside of a fair value gap, then now it could be some good confluence. If we are looking to enter and we hit the orb and we reject it and we get an inverse fair value gap in the orb to go to the downside, then that's when we would enter. We don't want to just enter off of every inverse or just enter off of every fair value gap, because that's just not how the market works, right? So let's just go in and find fair value gaps, right? So we have fair value gap right here. This wick did not overlap with this wick. We have a fair value gap right here. So this is how you just find fair value gaps. I'm sure it's super easy. You might even be able to get an indicator for it, but it's not that hard. Yeah, so that is liquidity, and that is fair value gaps and liquidity, internal liquidity, external liquidity. So external liquidity is just going to be where people have their stop losses, where banks are looking to place orders. And so it's going to be the highs and lows, previous session highs and lows. It's going to be our liquidity, buy side liquidity, sell side liquidity. When somebody says that, it just means the liquidity above price is going to be buy side, the liquidity under price is going to be sell side. It's very simple. Just a lot of complicated words to confuse people, honestly. Okay, now I'm going to show you exactly how these key levels work with the orb, right? So we're going to put everything together. We're going to find our key levels and we're going to find our buys for the day. So let's find our key levels. We have this unswept high, right? Let's mark it. Unswept high. Now let's find our low. We don't have any highs above this high, so that's going to be our only one for today. We did have this low right here. Price swept it, so this is going to be our low. And then if we look to the left, we do also see this low right here. It's kind of far behind, but we can mark it, all right? Okay, so we have our highs, we have our lows. Let's find our buys for today. We can see that price is breaking structure to the downside, and we are respecting a 1 hour fair value gap. I just taught you guys a fair value gap. We are respecting this 1 hour fair value gap. We are creating bearish market structure. We had a shifted structure. Okay, we can go to the 4 hour and we can see that we are also creating bearish market structure. Rejecting this, shifting structure, right? We're disrespecting bullish structure. So I'm gonna drop down to the 15 minute. I see that we are respecting this 1 hour. And then I'm going to mark my first 15-minute candle of the 9:30 a.m. open. So at 9:30 a.m. open, that is when all of the institutions, all of the banks, that's when all of them are coming into the market, and that's when we have the most volume, right? So that's going to be our opening range breakout, and we're going to mark that first 15-minute candle once it forms. So about 9:45 EST is going to be when it closes. It opens at 9:30. Yeah, so whatever time zone you're in, you're going to need to calculate that. And we're just going to mark it wick to wick. So our bias today is most likely bearish. We're going to be looking bearish today, right? So if we drop down to 1 minute, after I mark my first 15-minute candle and I have my bias, I drop down to the 1 minute. So now let's see what price does. We have a break to the downside. I can anticipate that price is going to sweep this level. Okay, we have our retracement and then we have another break. So this would be a great entry. The only thing is risk to reward is not good. I'm always looking for at least a 1 to 1.5. This is a 1 to 0.7. So I'm not entering this trade. I want to wait for a better retracement and a better entry because, obviously I want to make some money and I don't want to be risking more than I'm making, right? So as you can see, we took out this low. The trade played out. I mean, we kind of missed it just because I don't want to take that risk and enter a trade when you have liquidity so close. What you could do from this level is if you want to play it a little, I mean, it's not risky. But if you go for a 1 to 2 and then when price taps this liquidity, you just go break even pretty fast, and it's basically a risk-free trade. And if it keeps going, you can catch that trade, right? Boom, you catch that trade. And then now let's see what price is doing. Price is basically disrespected this liquidity, and you can, oh, I'll teach you that in a little bit. So we swept this liquidity. We had a good retracement into the orb. We inverse this fair value. See, look, that's also what I was telling you guys. Also why this is a good entry. When I say we can look for an inverse fair value gap on entry, we created this little 1 minute fair value gap right here. We inversed it with a lot of bearish momentum, and we closed outside of the orb again. We are bearish. It is going in the direction of our bias. This is a very good trade to take right here. A lot of you guys say that you guys have entry or have problems entering with the orb. It should make sense when you're entering, right? We have a pullback. We inverse the fair value gap. We're creating an evening star formation. We have a lot of bearish momentum to the downside. We're closing outside of the orb again. We're bearish, going with our bias. I think I said that already. And it's targeting liquidity. Say if liquidity was down here, this would be a perfect trade to take. Put your stop loss above that high, and you want to target like a 1 to 1.5. This would be a perfect trade, but liquidity is not right there, so we don't take that trade, right? Or you can do, you know, what I just said, you know, just go break even at that liquidity level, which would also be a good trade to take. So what happens here? Price pulls back into the orb. What do we do here? We are bearish still. Lower high, lower low. We tap into the orb. Price is pushing out, and then we also see that we have this untested liquidity, right? Untested fair value gap, bearish fair value gap. We are respecting it. So we have a 2 minute and a 1 minute and a 3 minute fair value gap that we are respecting. We pulled up into it. Boom. We have some good rejection. Buyers come in, sellers immediately push them down. We come tap back into the orb. Sellers push them down. What you can do here is enter. Put your stop loss above this candle that created the fair value gap. And then you can target either this low or this untested liquidity. Honestly, let's see how this plays out. I'm going to target this liquidity. I would probably just go break even right here. After price hits this low, I'll go break even. It'll be a risk-free trade. And this would be the safest take profit. And then this would be the take profit if you just got balls of steel and you just want to catch that low. Because I mean, price is moving towards liquidity. This is a pretty strong draw on liquidity. I think it's a New York low. Yeah, this is a low. I think this is the week opening gap when the price opened. So that's a pretty strong draw on liquidity. Now let's see how this plays out. All right. Okay, we hit that take profit. Yeah. And let's see what happens. So we hit the safe take profit, right? This would be the safest take profit that you can have. This would be a risky take profit. As you can see, we never hit this take profit. But as you can see here, once we swept this low, you have this inverse of a fair value gap to then take to the upside. So this would be actually a good trade to take to the upside, right? Since we swept liquidity, I haven't taught you guys that yet, the different entries that we can take with the orb. So I'm going to just keep it simple, and we'll get into that in a little bit. So yeah, so that's how we enter the orb, and that's how we use these key levels. We use our bias, and we use liquidity to target liquidity and all that with the orb. It's very simple. My strategy is so simple. It's insane. There's no BPRs, ICT, all this type of shit. I mean, it's just liquidity. The price is always taking out liquidity. Always, right? Okay, now let's just go out, and I'm just going to show you guys a lot of scenarios. I'm going to show you guys how you guys need to show up every single day to the markets. I'm on the 15 minute. I mark out my highs and I mark out my lows. This is my high. This is a low. And then this is also a low, right? So we have two lows to the downside. We have one low to the upside. We know price is always looking for liquidity to take out liquidity. So we want to ask ourselves, that's also one thing you want to ask yourself pre-market is, which liquidity do I think? Do I think we're going to take out buy side liquidity today or sell side liquidity? Because we're going to take out one of them. Price is always going to take out buy side or sell side, unless we're just having one of those choppy days. But if we're having like a good day, and if we're having a choppy day, then we shouldn't even be trading at all. But yeah, so we got to determine, is it more probable that we take out buy side liquidity today, or is it more probable that we take out sell side? So I see that we have sell side down here. It's very far from price. I don't think we're taking out sell side today. Buy side, I could anticipate for us to take out some buy side liquidity because it's right there, right? We are respecting this 15-minute fair value gap, Morningstar formation, inverse this fair value gap right here. So that's a good indication that we can probably go up as well. We are bullish. This is not really giving me anything to go to the upside yet though. And the 4-hour, I just see that we have a shift of structure, that we're bullish now. Okay, so I have more confluences to go to the upside more than the downside, but I don't really have a lot of confluences, but I do have more, right? So yeah, and then we also have this unswept high that's just sitting right here as well. And we do also have this unswept low that is sitting under here as well. So what we can do is we have our bias, we're looking for buys, and we marked out all of our key levels. That's what we want to do, is mark our key levels, find our bias, and then mark our orb. Once we do all of those three things, then that's when we drop down to the 1 minute and we're just waiting for a break, right? So we want to find a break. We have a break to the upside. No, we do not enter straight off the break. We wait for price to come and retest, and then we can enter our trade, right? So we're retesting the orb, see what happens, and we have a push outside the orb. So what I see here is price broke above, so we have a confirmation that price probably wants to go to the upside. We have inversed this fair value gap, okay? We have closed outside of the orb again, pushing us outside, showing us that the buyers want to go up. We have this engulfing candlestick. We're having bullish momentum. Why would we not take this trade to the upside and target this liquidity, right? So I enter my long here. I target the liquidity, and then I can put my stop loss at a point where if it gets hit, we are wrong. So we have this fair value gap right here under us that we are respecting. We are respecting this fair value gap. Boom, bullish, bullish. We want to put it under this fair value gap because price can come back and retest it to then push back up to the upside. And let's see what happens. Boom. We tap back into this fair value gap and we are bullish. We close to this would be, you know, a good entry as well. If you didn't take that entry, this would be a great entry to also enter right here. Put your stop loss right there and then target the same thing. So you're getting 2 entries on this trade, not just one. Price pushed up, we come back and we push up off of this fair value gap again. Very well respected fair value gap. And then as you can see, we hit take profit. Very nice trade, very simple. We marked our key levels. We found our bias. We marked our orb. And then we drop down to the 1 minute, wait for a break. Once we get a break, we can wait for a retest. Once we get our retest, we wait for a rejection. Once we get our rejection, we enter our trade, right? Okay, so now I'm going to show you guys a more advanced entry, right? Okay, so now that we have swept this liquidity, this is no longer a level that we need to be respecting. And this is also a level that we can mark, right? And even before that, actually, I'm going to teach you what this advanced entry is. Advanced entry is when we hit a liquidity level, we can actually get the reversal on that, because price usually when we hit these liquidity levels, we go up to them and we have a reversal. That's why we put them as our take profit, because we don't want to be going anywhere above that level because price can just reverse. So as you can see, we swept liquidity. I didn't get enough rejection here to actually enter. And usually we can take this back to the orb and enter this trade to the downside, because look, as we sweep this liquidity, price goes down. We usually have a reaction off of it, right? And usually this will go down to the orb. In this scenario, it didn't. But since we swept this liquidity, this would be our new liquidity to sweep, right? This is where people have their stop losses at. This is where people just entered and took sales right here and put their stop loss right here. The price is going to come and sweep them out, right? And then this is what we want to wait for, right? We want to wait for clear rejection, right? If you can look at this candle, you look at these candles, they're not going up, they're not going down. They're literally just consolidating, right? So as you can see, we reached this area. We're literally always in the same position. We were in the same position for what? This is like 10 minutes. How many candles are this? This is 11:01. This is 11 minutes that we were just sitting at this area rejecting it. This is beautiful rejection when you look at this, right? The candles are literally, they're small and they're very indecisive, and we're getting a lot of sellers. See, look, we have bigger sellers than we do buyers. Every single time we come up here, price is pushing them down. We have this evening star formation and a bearish engulfing candlestick. this would be an opportunity to enter off of this rejection of liquidity. Put your stop loss above those wicks, and then we can target the bottom of the orb. This would be a safer take profit right here at this lower liquidity. This would be what I would probably do, but you can target the orb if you want, you know, the crazy R. But boom, and as you can see, we do end up taking that take profit and both take profits actually. So we take this take profit to the orb, and we can take this take profit as well. But and then once you look at this, we see that now price is pushing to the orb, and we are not getting any buying momentum, right? So we look at this market. As you guys can see, we are rejecting the top of this orb. Sellers are pushing them down. We can actually enter off of all that sellers, the bearish momentum, price is going down. We can enter because we're rejecting off of the top of this orb. We can put our stop loss above these wicks, and then we can just target the bottom of the orb. It's going to be where also a lot of liquidity is, and then we can watch this play out. And as you can see, this absolutely smashes take profit. So you can take, there's 3 entries when it comes to the orb. There's going to be the break and retest. There's going to be the liquidity sweep. There's actually 4. The first one is going to be the break and go, just entering shit off the break. That one is a lower probability. I don't take that entry at all actually. But there's the break and go, just enter straight off a break. There's the break and retest. There's the liquidity sweep. So I showed you the break and retest, showed you the liquidity sweep. And then there's also the internal orb, right? I'm going to show you guys a little bit more examples of the internal orb. There's a few different ways that we can trade it, right? Okay, so what do we do here? We mark out our highs and lows. We have this high, untested high right here. We have this untested high right here. We have this untested high right here. We have this low that price has just swept. Let's keep that in mind, okay? So now let's form a bias. Like I just said, we just swept this low. So now we can be looking for a reversal to the upside, right? So that's a confluence, right? We swept it low. We are still in a bullish fair value gap. Sweeping this low. The 1 hour really isn't telling me much. Okay. 4 hour is bullish. Not telling me much as well. 15-minute, we are bullish. So everything is bullish, and we are just sweeping this low. So, and we don't have any lowers. We don't have any sell side liquidity to target, right? As you can see, we would have to target all these lows down here, and that is just not realistic, right? We have a lot of buy side liquidity to target. I mean, we can even mark these highs right here. So we have a lot of liquidity to target to the upside, and as we know, the price is always moving towards liquidity. So if there's a lot of stop orders up here, the price wants to go and take those out, right? So we're sweeping this low. Most time frames are bullish. Let's mark our orb. We have a bullish bias, and I'm gonna show you guys something real quick. So we have a bullish bias, and we are sweeping liquidity. So in my mind, I'm either looking for a fake breakout or a rejection of the bottom of the orb, right? So the market, or the candle closes, and then we go down, we skip some candles. As you can see, like I said, I'm either waiting for a rejection of the bottom of the orb or a fake breakout. In this scenario, let's see what we get. We get a rejection of the bottom of the orb. Price taps the bottom of the orb and instantly rejects it with a lot of buying pressure, right? So you enter your trade right here, put your stop loss under this low, and then we can target the high of the orb. A very beautiful trade. This is the internal orb entry. It's a very nice trade. I love it. And also, boom, let's see. We also just inverse this fair value gap. We entered before inverse, but then once it inverse, that's even more confirmation that this trade will play out. And then once we hit this level, we could go break even. So it's a risk-free trade. Boom. And then now let's see how it plays out. And then boom, we smash full TP. And then we see price has a break to the upside. We are not getting any clear rejection. Price is choppy. Boom, we have a second break outside the orb. What we could do here is we have some nice rejection. We broke above. We did this, and then we broke above again. We can see that the buyers are trying to push price up from this level. Could enter a buy position right there. Put your stop loss under these lows and target this high, and then we can watch how this plays out. Multiple entries on this one, and boom, we smack perfectly take profit, right? And that's why we have these take profits at these liquidity levels, because as you can see, when price hits these levels, it has a big retracement. We hit this level, and then that's where all the sellers were waiting, and you pushed them down, right? And went all the way back to the orb, right? And then we hit the orb again, and then price went all the way back up. So it's just a lot of liquidity. Price is always moving towards liquidity. Just want you guys to remember that. And then we have more liquidity for the market to take out up here. Do we take out these highs? And when you guys are trading like the break and retest or the liquidity, I see a lot of my students, they enter early. They don't really wait for a lot of rejection because they're trying to catch that move. But you have to wait for confirmation. If you're entering these trades without confirmation, you're going to be wrong a lot more times than you're going to be right, because we don't want to try to predict the market. We want to try to listen to the market and just follow it. When we try to predict the market, we skip the confirmation and the market just ends up fucking you, bro. Like, come on. So you want to wait for a valid rejection, wait for these inverse fair value gaps, wait for these engulfing candlesticks, wait for that second break of the orb, wait for the bullish or bearish momentum. Wait for a rejection of the orb and the fair value gap inside the orb. There's a lot of rejections that we have to be waiting for to make sure that the price is going in our direction. This is the chapter that everything else has been building towards, the opening range breakout. And I'm going to tell you something before I get into this strategy. I've spent years studying trading, and I've went through thousands of setups. EMA crosses, VWAP strategies, ICT concepts, order blocks, SMC, all of it. Some of those things have an edge, some of them are overly complicated, and some of them are just noise. But the orb is the one strategy that survived everything I threw at it. The one setup I kept coming back to because it was clean, logical, and it had a real edge. Now, here's why the orb matters. So at 9:30 a.m. Eastern, the New York stock market opens. And here's what happens in those first 15 to 30 minutes that makes this moment unlike any other time of the trading day. Overnight orders get filled, pre-market positions get adjusted, the news from the morning gets priced in. Every market participant, retail, institutional, algorithmic, is reacting to the same opening simultaneously. That creates the most liquidity and volatility of the entire trading day. So price is moving fast, decisions are getting made, and the market starts searching for a direction. Now, here's something that changed everything for me when I first learned it. Statistically, 90% of the time, the high or low of the entire trading day forms within the first 90 minutes of market open. 90%. That means at about 11 a.m., the biggest move for the day has already happened. The decision has already been decided and the big money has already made their move. And the orb strategy specifically targets that window, those first 30 minutes after open, to identify which side the market chose and then hop on board. We're not predicting, we're following, and there's a massive difference. The opening range is the high and the low of the first 15 minutes of trading after the 9:30 a.m. open. I personally use the 15-minute opening range. Some traders use the 30, but the exact time frame matters less than actually being consistent. Just pick one and stick to it. Okay, so all we're doing, once this candle closes at about 9:45, that's when that 9:30 candle is going to close and form. All we're doing is we're going to grab this box, we're going to drag it, and then we're going to mark that high and that low. Now these are our two key levels for the day. We have the orb high. This is going to be the top of the range. If price breaks above it, gives us a retest, then we can be looking for long. We have the orb low, the bottom of the range. If price breaks below, we can wait for a retest and then look for shorts. Like I said earlier, long equals buys, shorts equals sells. Buys means we're looking for the market to go up. Sells means we're looking for the market to go down. Bullish means that the market is in an uptrend, and bearish means that the market is in a downtrend. And these two lines are going to be our game plan for every morning. Okay, so here's the exact process step by step that I run through every single morning. Okay, so at 9:30, the market opens and we do absolutely nothing. We're going to wait for that first 15 minutes. So at 9:45, that's when we mark our range. And that's when we should already have our bias, for the day. We should already have all of our liquidity and key levels marked out for the day. And then all we do is wait for 9:45. Once 9:45 hits, then that's when we can drop down to the 1 minute, wait for either a break to the upside or the downside, depending on where our bias is. And then we can wait for the break, retest, enter. There's a multitude of different entries that we can take. Now, doing this is probably the hardest step for most traders. You're watching price move and it looks like money is flying by and you want to enter. Don't. The opening range isn't formed yet and you have no setup. There's nothing to trade. Sit on your fucking hands. So now we're on to step 2. Once 9:45 closes, we get this first 15-minute candle. We should already have our zones marked out for the day. Let's just do that now. We have this low here. If I go down here, we have this low as well. If I go over here, we have this low as well. So as we can see, we have a lot of generated liquidity. This is 3 liquidity levels, literally basically in one. This is a very strong target. And then pre-market, I see that price has swept these highs, right? So price just swept these highs. What do I see? I see that we just swept these highs and we get this nice rejection candlestick of these highs. Big. So as I told you guys earlier before, the buyers were all the way up here at one point, and then once we got up all the way up here, the sellers came into the market. They were sitting at this high. Look at this high. Boom, sellers come in. Boom, sellers come in. Boom, sellers come in. So they're sitting at this high. We sweep this high, and all the sellers come into the market. I can see that we're rejecting. My bias is to be selling. Let's go to the 1 hour. 1 hour is just choppy, no clear trend. I mean, I can obviously see that we are bearish, but this right here is choppy price action, no clear trend. 4 hour is bullish, you feel me? But we don't have any liquidity to the upside, or we just swept all the liquidity to the upside. And this 15-minute candle is telling me that the sellers are in control of the market right now. We are bearish on the 15-minute. We are respecting this 15-minute fair value gap. We can mark that out actually. And so we have our bias. We have our key levels marked out, and we have the orb marked out. So what do? We can drop down to the 1 minute and then wait for a break in our bias. Okay, we have our break. What I was saying earlier, the break and go method, I haven't showed you guys this yet. You can put it above the 15-minute fair value gap and just target liquidity. What is my chart doing this? Just target some liquidity, let it play out. Bam, smash, take profit. So that's the break and go. And then now we see that we are hitting this liquidity level. What did I tell you guys before? We hit liquidity, we sweep it. Price is most likely going to reverse if we reject it. So we're obviously rejecting it here, right? We have this rejection. You can see that we have no wick right here. Price has no wick. We see that once this closed, all the buyers just came into the market. So a lot of buyers are sitting at this area. Bullish engulfing candlestick. We also inverse this fair value gap. Respecting the fair value gap. This is a beautiful trade to enter to the orb. Now we could put our stop loss right there. And then we can just target the orb and let's watch it play out. Boom. Beautiful trade. Smash, take profit. Just like that. And then we can now take trades off of the rejection of this orb, right? So you can wait for a tap into this fair value gap. 15-minute fair value gap. We also have a 1 minute fair value gap right here. Price just tapped into that. So now we see how we can reject off of this 1 minute fair value gap. Rejecting it pretty well, and then we have another break to the downside. So this would be a great entry to take, would be the break and retest. So I showed you the break and go, the liquidity sweep, and then now we have the break and retest. Put your stop loss right there. Take profit at this low, because now once these get swept, they are no longer key levels anymore, and now this is a key level, because this is where all the buyers came into the market. Boom, and we go straight to take profit, take out all the buyers. Buyers come back into the market, and then they push price up, and boom. You see, inverse this fair value gap. It's very, 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 very nice, right? Okay, so now I'm gonna break it down step by step. So step one is we wait for 9:30. 9:30 opens, we do absolutely nothing, and we're just waiting till 9:45. Step two, 9:45 comes, and we're just marking the opening range. It's gonna be the high and the low of that first 15-minute candle. So 9:30 to 9:45. And then step three, we're gonna confirm our bias. We're gonna go to the 1 hour, the 4 hour, and the 15-minute. We're going to mark out all of our key levels and see what makes the most sense. Are we going to take out buy side liquidity or sell side liquidity today? Then step four, all we're going to be doing is waiting for a breakout. We want to either wait for a breakout in our direction, and when you see a breakout, you don't want to just enter off the breakout. Usually I wait for a retest, or if you don't get the retest, you can just take the liquidity sweep entry. And step five is to wait for the retest. Once we get that retest, make sure you get rejection. Like I said before, rejection can be inverse fair value gap, it can be rejection candles, it can be candlestick patterns, it can be rejection of a fair value gap, it can be a lot of different things, but you just have to put together a lot of confluences that our trade is going to go in a certain direction. That's all trading is. It's just putting together a number of confluences and creating a bias. What makes the most sense? Does it make more sense for a price to hit this high or this low? That's literally how simple it is. And then step 6, once we get that rejection, we look to enter. Now, let me explain why this isn't random, because this is the part that convinced me to commit to this strategy. Think about what the orb level represents. Thousands of traders and institutions watch that same level form. That high or low is on everyone's chart. And when price breaks above it, prices make it a statement. The market is saying buyers are in control and we're going higher. And in some scenarios, depending on where liquidity is at for that day, we could see that we can have a fake breakout and we can go take out that liquidity to then go to the downside. That is why it's important to mark out your key levels and not take a trade just straight off the break. You want to see if it makes sense. So if we have a liquidity level right outside the orb, we do not just want to enter even if we have the break and the retest, just because once we hit that level, then price is probably going to reverse. But if you know what you're doing, like me, sometimes you can take a trade like that, but you have to be very precise. And once price hits that level, you just got to make sure you got to break even really fast. And there's certain ways to tell if that level is going to be respected or not, if we're rejecting it or not, or if it's even going to reverse the markets. But when price comes back to reach this level, here's what's happening under the surface. Traders who missed the breakout are now waiting at that level to go long. Institutions that need to buy more are using that pullback to add more positions. And the stop losses from earlier positions are sitting right under that level, providing additional fuel for when that rejection happens. That convergence of orders at that exact level, that's why the rejection happens with force. And that's why the trade works. And we're not guessing, we're identifying the place where the market already told us it's going. And we're just entering when that side gets confirmation. I've heard this question hundreds of times. An 83% win rate sounds too good to be true. Now, let me be completely transparent. That number comes from this setup when all 6 conditions are met. When I skip a step, when a rejection isn't clean, when I'm trading against the higher time frame, when there's a level in the way of my target, the win rate is going to drop. That 83% is not magic. The 83% comes from the discipline of following every single rule on the checklist every single time. The students who see the worst results trading this strategy are the ones who learn the concept and then start bending the rules. They say the rejection wasn't perfect, but I took it anyway. The 15-minute and the 1 hour were showing resistance, but I entered anyway. I know I should have waited, but every time you break a rule, you're no longer trading the strategy. You're guessing, and guessing does not have an 83% win rate. But when you follow the rules, the math is real, and I've documented it. I trade it live every single morning in front of all my students. The setup works. And if you want to trade live with me, just click the link down in my description and you can do that. Here's the single biggest difference between a profitable trader and a losing trader. And it has nothing to do with the quality of their trades. The profitable trader knows exactly where they're getting in, where they're getting out, if they're wrong, and where they're taking profit before they even click the button. The losing trader gets in on a feeling and they move their stop loss when the price gets close. And they hold the trade hoping it comes back. I've been that second trader and I know exactly how that ends. Now, let me teach you how you never have to be that trader again. Okay, so the entry trigger for the orb is specific. All we're doing is entering on a confirmation candle after the rejection. Now, here's exactly what I look for. Option A, a strong rejection candle. Price comes back to retest the orb, a single candle touches the level, and then we have a strong rejection pushing price away from it. Whether that be a bigger, small candlestick body, a long wick pointing away from the level, or we have no wick at that level at all. That candle closure is going to be your entry trigger, and we're going to enter right at the open of the new candle. Then we have option B. The price comes back and tests the level. First candle touches the level with a wick, but it doesn't close strongly. Then we get a second candle. That gives us a strong closure away from the level. And then we can enter off the open of that third candle. Then we have option C. Price comes back to test the level. We are consolidating in the level. Price is getting very choppy. Then we have something like an inverse fair value gap, or we close outside of the orb again. We can enter off of that closure as well and take it to the upside or away from the level. Option A right here. So price had that break, and then we finally retested the area. We had one tap into the area, and then as you can see, we have no wick right here. We have absolutely no sellers coming into the market, just pure buyers pushing price all the way up. A lot of buying pressure. We can see that the buyers are taking control of the market. enter off this candle closure. Okay, so this would be option B. We have price coming into the wick. We're wicking in. We don't really have a strong closure, but then we have price does the same exact thing again. And then we have that strong closure to the upside. We can enter off of this candle closure and take it to the upside here. And I'm going to teach you how to place your stop loss here in a little bit and where to target. That would be option B. This is going to be option C. Price is obviously consolidating at the area. We have this fair value gap right here that ends up getting inversed. And we have that second closure outside of the orb right here. So this would be a good entry right here after this candle closure. And I'm going to show you how to place your take profit and stop loss here in a little bit. Put your stop loss down there, target up here, and yeah. Now, what is not an entry trigger is when price is grinding through the level slowly with no rejection, or a wick that touches the level but the candle comes back and closes inside the range, or a small candle with no conviction to either direction. Now, if you're not sure if a rejection is clean, it's not clean. The best setups are obvious. If you're debating it, do not talk yourself into taking a trade. As you can see right here, we have the break to the upside. Price pulls back super deep. We have no rejection. This is what we call a shitty entry. We would not be trading this. Price is just chopping around. We're having no volatility. And we didn't even reject the level right here, right? Now, for stop loss placement, this is going to be the most important decision for your trade. Your stop loss is not optional. If you trade without a stop loss, you will eventually take a catastrophic loss that will blow all of your accounts. This is not a speculation, it's guaranteed, especially in these Trump markets. For my orb setup, here's exactly where my stop loss goes. Okay, so if we're looking for a long trade, we're looking to take a trade to the upside. We want to enter right here. So this would be our entry. And we can put our stop loss right here, or we can just give ourselves a little room and put it like right here. That would be like under this fair value gap. This would be, this wouldn't be a terrible stop loss, but price can easily just come back and retest the level. This would be a better stop loss. Price can come back and retest the level, and we still have some space to, not get stopped out. And this one, you could also put it like right here or right here, like this one, where I would put my stop loss just because the risk reward would have to make sense. And I would most likely be targeting this liquidity level. I would put it right here. I want a 1 to 1.5, so I'd probably put it like right under this fair value gap, hold it a little bit longer. And if I saw this, I would probably just like end up holding my trade till here, because we obviously disrespected this liquidity level. So then we're going to move to this one. So this would be a good trade. This one stop loss is a little bit more confusing for a beginner. Let's go ahead and show you guys another example. Okay, so in this scenario, we have a break to the downside. We have a good retracement in this 1 minute fair value gap. We have a good rejection, and we have our second break. So we would enter our trade right here, and then our stop loss. Our stop loss is going to be either right here. Me personally, I would put it at this high. This is where I put my stop loss, and then I would target this liquidity for my take profit. And yeah, so you always want to target liquidity, and we always want to put it at like a lower high. So this would be our lower high. We broke this lower low. We created this as our lower high. So if we break this, we're shifting structure, and price is probably just going to be wrong. So you want to place it at an area where price hits it. You're probably wrong. In this scenario, if you want to be a little bit safer, and you're okay with having a bigger stop loss, you can put it above here. This would be like a lot better, a lot safer stop loss, maybe for beginners until you're actually comfortable trading the strategy. That's exactly how I do it. Just put it at the safest option possible. I'm gonna go ahead and show you guys another example. All right, so we have another example right here. Price has a break to the downside. We are rejecting this 1 minute fair value gap. We are respecting it very well, pushing outside, pushing outside, pushing outside. We could enter our trade either, after either one of these, pushes. You can enter right here, enter right here, enter right here. Me personally, I would probably enter off that second one. That was giving the most confirmation. And then I can just put it either right above, the fair value gap like this. You can put it like this. You can make it a little bit tighter. Me personally, I would probably have it somewhere like this. Then you can target lower liquidity. In this scenario, where's our liquidity? our liquidity would be this low right here. So we would be targeting that for a good 1 to 3. That would be a beautiful trade right here. Dump straight to take profit, just like that. So always want to target key levels for our take profit, and then for our stop loss, we just want to put it at a point to where if we get hit, then it's most likely wrong about our trade. So right here, this is where your stop loss should really be, above this fair value gap, just in case, price just comes up and, sweeps you out. And then you want to target this liquidity. That's how we're usually able to get a lot of good R trades. And then you can also take that inversion to the upside once we hit that key level, right? Okay, so every trade I take needs a minimum of a 1.5 to a 2R. So that means I need to be making at least double my money or 1.5 times my money. So if my stop loss is 10 points, that means my take profit has to either be 15 or 20 points. And the points, to calculate your points, is going to be that number right after stop. So after stop, it says 10.25. That's 10.25 points. And then once it says 42 right here, that's going to be ticks. So we have 10.25 points, 45 ticks, or 41 ticks, sorry. So if you ever want to calculate how many points you're risking, just grab this tool that I told you guys to favorite, and it'll tell you how many points you are risking right here. And then for your take profit, it's the same thing. Right after target, it says how many points you're risking. Right after target, it says how many points you're going to make. In this case, it's 24. Now, as I just showed you guys, our target is always going to be set at the nearest key level in our direction, whether that be the previous high if I'm long or the previous low if I'm short. And if there's no key levels nearby, then I usually just go for a 1 to 2. And now this is the thing that some traders forget when trading the orb. You want to make sure there are no key levels sitting between the entry and the target. Like if there's a major resistance at like a 1 to 1 R, I either don't take the trade, or I take partials at that area, or I just go break even at that area. And you have to know, and you have to watch and look at the trade to make sure there are no key levels. So if we do hit that level and you don't know, you don't manage risk, you don't move your trade to break even, you don't take partials, then you will be just reversed on and you can hit your full stop loss. Now, once you're in the trade, your job changes completely. You identified the setup, you checked the conditions, and you entered. Now your job is to let the trade work. The biggest mistake I see most of my students do is moving their stop loss to break even too quickly. Like if price moves 5 points in your direction and you put your stop loss to break even, price comes back, takes you out of break even, and then ends up hitting your full take profit. And then that just messes you up psychologically, and you're probably just going to be thinking about that the whole trading week. Like, oh, I could have made so much money. I got scared. I didn't trust my strategy. And that stems from, fear, FOMO, all those emotions that we need to get rid of if you want to be a good trader. Also, a good thing to combat this is to probably lower your risk. If you're lowering your risk, or if you're moving your stop loss to break even too quickly, you're probably, scared to lose that money. And if you're scared to lose the money, you're probably risking too much, because trading is a losing game. You're going to lose. And if you're scared to lose, you're going to lose even more. So what to do to be less scared is to know that it's a losing game and to know that this is a percentage game. If you know that this is a percentage game, all you have to do is really just get a 50% win rate. If you know that you're gonna lose 50% of the times, 5 out of 10 times, then you'd be like, okay, that was just one of the 5 losses that I need to take, right? And if you have a 1 to 2 R every single time, you'll still be up double the amount, even with the 50% win rate. So if you're scared to take a trade, that means that you're risking too much. You don't understand this is a numbers and percentage game, and that all the losses are just, putting in that stat. They're just putting in numbers, putting in statistics, and one single loss just doesn't matter. Here's my rule. I don't move my stop loss to break even until I pass a previous high or a previous low. Now, say we had that break to the downside, the 1 minute had that break, and then it had that retracement back into the orb. I'll usually put my stop loss at break even. Once we break that low that we made when we had that pullback, put my stop loss at break even. But it depends on how low that pullback is. If it's not that low, it's only a couple points, I'll usually put my stop loss at break even, around 50% in profit. Now, this is how it looks on the charts. See, I would probably go break even right here. Price had that move to the downside. We swept this move right here. I would go break even, because sometimes price can sweep this level and then reverse. And then right here, you see that this is way too close, so I can't go break even right here. So in this scenario, I would probably go break even 50%. So once price reached down here, yeah, I'm moving my stop loss to break even. Once we're somewhere down here, thankfully this trade didn't come out and take us out of break even, and then we still do come back and hit full take profit, right? Because usually if prices come in, this far, about to hit our take profit, and then it comes all the way back up, most of the time we either could just be getting a better retest, or sometimes, during these markets, the Trump and war, we could just get a big move to the upside. So, and if your stop loss gets hit early, it's okay. That's just the trade not working. It's not 100% win rate. But if you follow everything on the plan and we end up losing, there's literally nothing we could do. That's probably like the best loss you can take. When I take a trade knowing I did everything right, I'm like, okay, that's fine. That's just giving me that one loss that I need to have my 83% win rate. It's just giving me that data. But yeah, that's way better than, knowing I did something wrong, knowing I didn't have confirmation, knowing I just wanted to try to get in early, and then, losing the trade. And I knew I should not have taken that trade, but I took it anyways. But when you should take this trade and then you lose, you can be at peace because you did everything right and there's nothing else you could have done. I want to tell you something that's going to sound backwards. Your entries are not what's going to make you money. I've seen traders with a 70% win rate blow their account, and I've seen traders with a 45% win rate be profitable for years. And the difference has nothing to do with their entries, it's all risk management. Now, here's the math that most traders never look at. So trader A, he has a 70% win rate. His average winner is $100, but his average loser is $400. After 10 trades, he has 7 wins, so that's going to be $700, but then he also has 3 wins, and that's going to be $1,200 worth of losses. So he's net negative $500, a losing trader. But we have trader B with a 45% win rate. His average win is $300, and his average loss is $100. After 10 trades, he has 4.5 wins. So that's going to be $1,350. Then he has 5.5 losses, which is going to be $550 worth of losses. So he's net positive $800, a profitable trader. The trader who wins more often is losing money, but the trader who wins less often is making money. The difference is risk management, specifically the relationship between the size of wins and the size of losses. This is the game, not finding better entries, but finding the right relationship between your winners and your losers, and then protecting it with iron discipline and balls of steel. We never risk more than 1% of our account on one single trade. So if your account is $10,000, the maximum amount you can take per trade is $100. And if you're trading on a $50,000 funded account, the max you can risk is going to be $500. Me personally, I only risk $250 due to how small the drawdown limits are. Now, why 1%? Because at 1%, it takes 100 losses to wipe your whole account. And that's basically impossible if you're trading with a real system that has a real edge. At 5% risk, it takes 20 trades. It's still unlikely, but now it's a conversation. It's still unlikely, but me on my live account, I do risk 5%. If you are more of an advanced trader, then you can risk 5%, nothing over that. And at 20%, 5 consecutive losses, you blew your whole account. And this is what happens to beginners all the time. The prop firms I use have specific drawdown rules. Most have a maximum loss limit, and that's going to be about 2 to 3%. So trading at 1% is very close to those boundaries. That's why I go down to 0.5% just to give me a little room, just in case I have a losing week, because sometimes those do happen. So for me to blow my account, I would have to lose 8 consecutive trades in a row, which when you think about it is not a lot at all. So that is why it is very important to control your risk, because with these prop firms, they have a very tight risk and you want to be able to control that so you do not blow the account. A lot of people blow their account in one day, risking 500, risking 1,000, then they'll lose that, try to make it back, overtrade, revenge trade. Next trade, they risk 500, lose it again, 500, lose it again. And now that is their account blown in one day. For me, it's literally physically impossible for me to blow any account in one day, because after I take a loss, I am off of the charts, and that'll be around $250, and I'll just come back tomorrow, win, and make double that. Now, here's where most beginners get lost, and I'm going to make it very simple for you guys. So on ES futures, the contracts are going to be a lot bigger and you're going to be risking a lot more. One full ES contract is large, so on about a 10-point stop loss, that will be risking about $500. So every point on ES equals $50. And on MES, those contracts are going to be a lot smaller, so a 10-point stop loss on MES will be about $50. 1 point only equals $5. So if your account is $10,000 and your max risk is 1% or $100, what you're going to do is divide 100 by 50. That equals 2. So we're going to be doing 2 MES contracts for a 10-point stop loss. Now say if you had a 13-point stop loss, you would do 13 times 5 because every point is $5. You have 13 points. You want to do 13 times 5. That's going to be $65. And then you're only risking 1%, which is $100. So now you divide $100 divided by 65, and then that is your answer would be how many contracts you're risking. Now, if your account is $50,000 and your max risk is 1%, that's going to be $500. $500 divided by 50 equals 10 MES contracts, or one full ES contract for a 10-point stop loss. So 10 micros or 10 MES contracts is going to equal to 1 ES contract, or what is known as a mini. So we have micros and then we have minis. So micro is going to be MES, and then ES is just going to be a mini. So we have micros, minis. Micros are going to be lower lot sizes, lower risk. Mini is going to be a lot higher risk, 10 times the risk. But that is not that. But I'm not on my phone on my calculator trying to determine how much money I'm risking. I just wanted to kind of give that to you just so you guys, if you guys wanted to learn how to calculate your guys' lot sizes, or you guys can't really figure it out sometimes, this is exactly how I do it. So if you click this trade button after you connect your prop firm or whatever thing with Tradeovate, I just click this trade button right here. It opens up this menu right here, so I can literally just enter, or I think actually first you have to go to settings, go to trading, and then go to something right here, project order for market orders. So turn this on, right? So when you turn this on, it's going to give you this thing right here, right? Because if I have it off, it's not going to give it to me. But right here, project order for market orders. I'm going to turn that on. And when I do this, when I drag it, it's telling me exactly how much money I'm risking. So say if I wanted this to be my stop loss, that's $675. I do not want to be risking that much. But in this position, you actually, that's way too big of a stop loss. Actually, no, I'm on ES, that's why. So if I go to MES, right, and I try to do that market order, see right here, and I want my stop loss all the way down here, but I'm risking $325. Just lower it down to wherever your risk is. So now 227, really want to risk. So 260, I would go here, $227. That's how much money I would risk. And then I just change my units. I'm doing 7 contracts on MES, and then you can set your take profit here as well. And it tells you exactly how much money you're going to make if you are right about your trade. Super simple. You just drag it to where your stop loss, or you want your stop loss to be, and then once you have that, you literally just click this button right here, or you can click this button and it'll instantly make this your stop loss and make this your take profit. And you just do that. Everything is set for you. You know exactly how much you're risking, how much you're going to make if you're right. Now, we calculate this before every single trade that we take. Calculate this before every single trade, not just a rough guess. We want an exact calculation. Now, here's a rule that has saved me from blowing my funded accounts more times than I can count. 2 losses in a single day, you are done trading. You close out your accounts, lock your accounts, and then you walk away. I don't care if the next setup looks perfect. I don't care if you're only down $200. 2 losses and you're done. But here's why. When you've taken 2 losses, your psychology is compromised. Whether you feel it or not, whether you think you're fine or not, your decision making is affected. You're in a subtle state of wanting to make it back. You're in a state where a third trade feels like a correction of an injustice. And that state is where blown accounts are created. I've never blown an account or failed an evaluation following the 2 loss daily rule. But I've came close to both by ignoring it. 2 losses, you're done. That's the fucking rule. When you're trading a funded account, risk management isn't optional, it's contractual. Here's the typical rules you'll be operating under. Most of the time, you're going to have a maximum loss limit. In this scenario, it's 2%, so that's going to be $2,000. You're going to have a profit target. It's going to be 3%, but once you're funded, you won't have a profit target. You'll just you'll be able to keep going past that. And then you're going to have a consistency rule. A lot of different prop firms are different. This one is 40%. That means one trade cannot be over 40% of all your profits, right? Then you're going to have a daily loss limit. This is usually half of the maximum loss limit, I'm pretty sure. So in this scenario, it is $1,500 or $1,000 you cannot lose in a single day, which for me is pretty much impossible. Like I just told you, the 2-loss rule. I can only lose $500. That's max I can lose in a day. Now, these rules aren't punishments. This is just the prop firms making sure you know how to manage your risk. If you can trade with these rules consistently, you can trade with them indefinitely. Think of it this way. The prop firm is your employer. They're giving you $50,000. The drawdown rules are them saying, prove you know how to manage money, and then we'll keep paying you. When I set up each new funded account, I start at 0.5 risk per trade, and then I only increase it after I had about 10 winning days. That conservative start protects my account while I calibrate my trading to that specific contract size. If there's one thing in this course that changes the way you think about trading, it's this chapter. Most people who want to start trading assume they need to have $20,000, $50,000, or even $10,000 of their own capital to actually make a serious income in trading. That belief stops more people from starting than anything else. It's also wrong. Proprietary trading firms have changed the entire game. And if you're serious about trading, this is the exact vehicle you need to be using. Now, what is a prop firm? I know I went over this a little bit earlier, but a prop firm or a proprietary trading firm is a company that funds traders with their capital. Now, here's the basic model. You pay a small fee, usually around $70 to $200 depending on the account size, to participate in what's called an evaluation. An evaluation is a trading challenge where you prove you can trade profitably while following certain risk rules. You pass the evaluation, you get a funded account with real money, real capital, in a real brokerage. You trade the funded account, and if you're profitable, the prop firm will pay you on those profits, and they usually give you 90 to 80% of those profits. So think about that. You're trading $50,000, you make $5,000, you're keeping $4,000 to $4,500, and you only had to put $70 to get access to that capital. Now, that math changes everything. Now, how do we pass these evaluations? Every prop firm has slightly different rules, but they mostly stay the same. They all have a profit target. Usually most of them are 6%. So on a 50K, that's going to be a profit target of $3,000. And then they all have a max loss limit of around 4 to 5%. And on a 50K, that's going to be $2,000 to $2,500. And a max loss limit means if you hit negative $2,000 or negative $2,500, your account is gone. And usually it's either end of day trailing drawdown, or in some cases it's intraday, but almost all of them are end of day trail down. And I recommend to get end of day trail down. But essentially what the trailing drawdown is at the end of the day, end of the trading day, say you make $500. So now your account balance is at 50K, 50,500. So at the end of that day, your drawdown is going to move up $500 because it's trailing you. They have your drawdown, which is $2,000, trailing you. So if you're at 50,500, your drawdown will now be at 48,500, right? But once you get to a certain profit goal on most accounts, some accounts they do stay like that, but once you get to like $52,000, that's when your drawdown would just stay at 50,000. And then you can just keep going as long as you do not get to 50,000, and you can build up that buffer. That's what we call a buffer. Now, some firms also require you to have a minimum number of trading days, and some actually only require 1 trading day. So you just have to look at the rules of the certain prop firm you're trying to get. Apex, Alpha, and Lucid, you can pass all of those in 1 day with the Alpha Zero, with the regular Apex account, and with the Lucid Pro. But these rules are not hard to follow if you're trading with discipline. The orb strategy with the proper position sizing and the 2-loss rule fits very comfortably within these parameters. Here's how I approach every evaluation. So week 1, that's when the account is still fresh and you don't want to put yourself in any drawdown. You don't want to put yourself in a negative balance. So I'm only risking 0.5%. That first week, I want to just get a good buffer on my account, right? Coming into week 2, if I got those wins, I'm green. I'm up about $1,000 on the account. I want to up my risk to 1%. Now I have that room. I have that breathing room. If I take a bad trade, I won't be in such a bad position. And then after the end of week 2, maybe I either pass the account, or at week 3, I just take a couple more trades or 1 more trade, and usually the account is passed. By the end of the evaluation period, we hit the profit goal. while staying in those risk parameters. And the average time I pass my evaluations, usually around 2 to 4 weeks. But now, usually when you get to that advanced stage, you can pass this account in 1 week. Usually if I'm just trying to pass evals, I might risk $1,000 a trade or $750 a trade, just because I'm okay with that risk. I already have a lot of prop firms. Just passing them quick is probably the best way. Just throw $70 on an account, pass it quick. But I strongly recommend do not do that. If you're not already funded, do not do that, because you're literally just wasting money, and then once you get funded, you have no structure, you have no strategy, you're building bad habits, and you're going to do the same thing on the funded account, blow it, and then your psychology's fucked, and then you're going through like, oh my gosh, I had a funded account and then I blew it, like I keep getting funded and I'm blowing it. And then you're really going to mess up your psychology doing that. Now, once you pass the evaluation, you receive the funded account. Depending on the firm, it might either be called a live account or a funded account. From this point forward, you trade exactly how you were trading during the evaluation. That is why it is very important you use risk management and you do not just try to pass these accounts in 1 week. Same strategy, same risk rules, same position sizing. Now, once you request a payout, the firm's going to process it. Most firms pay weekly or bi-weekly. I personally receive payouts from prop firms weekly. Now, here's the strategy once you have one funded account working. Get a second, get a third, get a fourth. Once you get that first payout, all we're going to do is put all that money into buying more prop firms. Most prop firms allow you to hold multiple accounts, just stacking up all these accounts. And people like me have millions of dollars worth of funding. Like Apex, for example, you're able to hold 20 accounts. Each account operates individually unless you use something that's called a trade syncer. I personally use a trade syncer to copy all my trades. So whenever I take one trade, it takes it on all the other accounts as well. Just search up tradesyncer.com. I'll probably throw it in the description. And you can copy trade 20, 40, 50 accounts if needed, if that's how many you have. Here's the mistake I see beginner traders make over and over again. They learn the strategy, they understand it conceptually, they feel ready, and they go straight into an evaluation. Or worse, they go trading a live account with real money before they've practiced even once in a simulated environment. And they fail, not because the strategy doesn't work, but because execution under pressure is a completely different skill from understanding a concept. But the good news is you can compress what should take months of real trading into 2 to 4 weeks with the right practice approach. Okay, so I went over paper trading earlier in this video. You understand how to connect it, you understand how to enter a trade, but here's how to start paper trading correctly. Treat it like it's real money. Every paper trade follows every rule. Position sizing, stop loss, take profit, the 2-loss rule. If you treat paper trading casually, you're going to build casual habits. And then those habits will carry into your real trading, and then you're going to blow accounts. Do it every morning at 9:30, mark your orb, mark your key levels, wait for price to form that first 15-minute candle, wait for price to have a breakout, wait for price to give you a retest, wait for price to give you a rejection, and then you enter off that rejection, put your stop loss under a point where it cannot get hit, or under a point where if it gets hit, then you are wrong, and put your take profit at a key level. And then I want you guys to track every trade. We're going to go more in detail in that in a little bit, but every paper trade goes in the journal. Your entry, your stop loss, your take profit, why you took it. Okay, so now we are backtesting. Backtesting is just when you go back 2-3 months, a couple weeks back in data using the bar replay tool. Like I said earlier in this video, I think that one is going to be $13. You cannot use this with the free plan, but it's not that expensive. So basically, it lets you go back in the past, any time in the past, and lets you play candle by candle on every time frame. So it's very powerful. You can see how your edge works over years of data. So here's the process. We're on the 15-minute time frame right now. This is Monday, March 23rd. So let's see. Let's go to the 9:30. Let's see the 9:30 candle open. Okay, 9:30 candle opens. This is how we're going to backtest. We see this is literally exactly what you do step by step, right? Watch me, please. So we're going to mark this 9:30 candle. Okay, then we're going to mark all of our key levels. Okay, we have a level right here. We have a level right here, level up here, and then we have these two levels right here. So this is all of our liquidity, right? Price is looking to sweep liquidity. A lot of retail traders enter buys right here, or in buys to see we're in this full fair value gap, and they want to put their stop loss here. A lot of people are in sells in this rejection. You know, they want to put their stop loss up here. A lot of people have their stop loss up here, and a lot of people have their stop loss down here, right? So the market is looking out to take buy side and sell side. So which one does it make more sense for to take out? That's what you want to ask yourself. So everything that I'm talking about is what you should be asking yourself when you're doing this, right? So we're in this 15-minute fair value gap, right? Price is obviously respecting it. Have this morning star formation and versus fair value gap. Okay, so we're respecting bullish order flow. 1 hour, we are very bullish as well. 4 hour, we just have shifted bullish. Okay, so I can see we're bullish. Price wants to go to the upside. We have some buy side liquidity to the upside. So let's just see what price does. Does it break to the upside? Does it break to the downside? If it breaks to the upside, we have a lot of confluences for it to go up, and we can be very confident in our trade. It breaks to the upside. Okay, now let's wait for price to retest, right? So we got the break. So we marked the orb, marked our key levels. We formed the bias. We waited for a breakout. Now we wait for a retest. Okay, we have a retest. Now we wait for rejection. This is every step that you need to go through step by step to backtest. This is how you backtest, right? You have the rejection. We in versus fair value gap. We close outside the orb again, and price is rejecting off of this bullish fair value gap. So we can enter our trade right here, put our stop loss under the fair value gap, and target this high. Boom, 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 boom. Second entry right here, and we smash take profit. Now I'm going to do this for you again, and I'm going to do it a little bit faster. Okay, it is 9:30 right here. Market open. Let's mark our candle. Okay, let's mark our key levels. Boom. Okay. Boom. Okay. Boom. Okay. Okay. We still have these two down here, right? Okay, so coming into market open. Now first we marked our orb, we marked our key levels. Let's form a bias. So me forming the bias this morning, right? I see that price has just swept this key level, this Asia or London low right here. We just swept it. So we swept the key level. I can anticipate for price to go to the upside. Okay, what else? 1 hour also sweeping the level as well. We are still bullish technically. And then the 4 hours not really telling us much. I mean, we are bullish. Price coming back here. I mean, I don't really see much. It's not really telling me much. So forming the bias today is basically purely off of the 15-minute today, right? So based off, putting together that we just swept this low and our nearest key level is all the way down here. We have a lot more buy side liquidity to the upside. So price is most likely going to take out these highs, then taking out those lows all the way down there. We have a lot more conviction going up to the upside. So this going into my mind, this is actually more of an advanced way of thinking. I did take this trade live with my students, and I'm going to show you the exact thought process behind it, right? So boom, that's why I was looking for bullish for buys today. We swept that. We had a lot of buyers come into the market. Big bullish candle right here, right? All the buyers came in once we swept that level. We're pushing up. We come back to that level. I was telling my chat, we're either going to have a fake break to the downside and go up, or we're going to reject the bottom of this orb and then go up. In this scenario, we reject the bottom of the orb. We get this beautiful engulfing candlestick. Buyers come in again. So buyers come in, buyers come in. I mean, this is a beautiful trade to be taking. I mean, obviously, the buyers are sitting at this level, pushing price up. You sit there, you enter right here. You target the top of the orb. And like I said, when you backtest, just click buy right here. Set your stop loss. But you also want to make sure your risk is good. So I would go on MES. I'm on ES just because I don't want to mess up my charts over there on the MES one. So go here. You would probably have to do like 5 contracts on MES to get 250. You want to make sure you're practicing your risk management, position sizing. Make sure your stop loss is good. Take profit. The reason my stop loss is under, I'm putting it under this low because we obviously didn't break it. We're holding this level. And my take profit is going at the target at the top of the orb because that is a key level in this scenario. And then we just let it play out. And let's see. Boom. It's beautiful. Okay, now coming into this market, it is 9:30. That's mark our key levels, right? We got the orb right here. Mark that. We had some levels down here. Oh, didn't mark. Some levels down here. Let's draw that out. We have some levels down here. Let's draw that out. Some levels down here. Okay, so far, I already see that we have 3 trend line liquidities. Very strong liquidity to this downside right here, that if price breaks down, we are most likely 100% taking out these lows, right? So that's a good confluence, right? We have a lot of sell side liquidity. Boom. Price is looking to take out sell side liquidity. And we even have a lot right here. Boom. Okay. And then we have some to the upside, right? We have these 2 to the upside, right? Nothing. So we already took out all this liquidity. Like I said, price is looking to take all this liquidity. And now once we take all this liquidity, we make a lot of liquidity to the downside that price needs to go and take out now as well. So coming into this market on the 15-minute, I see that we just swept all this high. We swept this high, we swept this high, and we swept this high right here, right? So we swept all these highs right here. The sellers were sitting at the top of this level, pushed all the buyers down. We had a very good rejection candlestick. So let's go to the 1 minute. The 1 hour, I can already see from the 15-minute that I'm looking for sales. From the 1 hour, I can see that we're having a lot of rejection at this area. Looking for sales. We're just pretty choppy though, no clear direction. 1 hour, no clear direction as well. So right here is going basically just purely off the 15-minute right here. Swept this high, a lot of sell side liquidity. Very good rejection candlestick. If I get a break to the downside and get a retracement, that would be a good trade. And we also could have had a liquidity sweep entry. I called this out on live. Let's mark this key level. When market opened, we had these key levels right here. 2 of these key levels right here that price came in and hit. Once we hit, we had a good rejection, a retest. So we can enter right here, do this, and then target the bottom of the orb. Would have played out perfectly. And then after that, I mean, I didn't enter the break and go. I mean, some of my students did. I don't enter that. I don't enter trades off just a break. So then we come down and take out all the liquidity, like I said. And then right here, at this point, all the buyers are coming into the market. I either entered right here. I'm pretty sure I entered right here, just straight off of this candle. Price came all the way down. I entered right here and I target the top of the orb. Okay, so this is our stop loss. We put our stop loss under this wick, and then we're going to target the bottom of the orb. And then, so let's enter, right? Enter. Let's drag our stop loss down here. Let's put our take profit up here. And then let's let it play out. Boom. We smack take profit. Now, that's a more advanced entry, something that I would take. This is the trade that you should take, and that I also took after this trade, right? So we tap. So we have the break, we have the retracement, and now we're waiting for a rejection of this orb, and then we want to enter and then target a key level. In this scenario, these are no longer key levels since we swept them. This would be our key level now, right? So, and this is swept as well. So we wait for a rejection. Boom, this is some sort of rejection. It's not clean, it's not clear. We need something more than that. Okay, this is a good rejection, right? We have this 1 minute fair value gap up here. We can probably enter our trade somewhere right here. Put your stop loss above there, and then target these lows, right? Now let's watch this shit. Wait, sorry. Let's do this. Put our stop loss up here. Put our take profit down here, and watch how this shit plays out. Boom. We smashed take profit. A beautiful trade right there. Went into this 1 minute fair value gap, rejected it very nicely. It's a very beautiful trade. I love it, right? So that is how you backtest. This is how you should backtest. Just go months, go couple weeks, go in the past, and just go through every single day. Mark your 930 orb, mark your key levels, find a bias, wait for a break in the direction of your bias, wait for that retracement, wait for that rejection, enter your trade, set your stop loss at a point to where if it gets hit, you were wrong about your trade, set your take profit at a key level, boom, you're fucking goated, right? Now, journaling. This is where you're going to turn your experience into growth. Every single trade, paper or real, this is where I journal my trades in a notebook. I just go in. I just say why I took my trade, what I was thinking during my trade. Was it a good or bad trade? And let's go on my journal, right? Let's see. Here it says, today we followed our rules. We waited to break the orb. We waited for the rejection of the orb. Then we got the IFPG, inverse fair value gap, and engulfing candlestick, and a second break outside of the orb. So I took the buy and it played out. We didn't enter off emotion or impulse, but discipline and strategy. The only thing is we closed before our TP, but price was choppy. We were up 1,000. We made 964 times 9 accounts, which is $8,661.10 today. So that is how I journal, writing down my emotions, writing down why I took the trade, and just basically just being disciplined about the strategy. Like if you do this, bro, you write down every single trade, and at the end of the week, you can look at your journal and say, okay, I'm not a fucking crash out. I know what I'm doing. Even if you had a losing week, you did everything right. You was like, okay, the markets, just didn't play out today. They were, they got us, right? But as long as you are disciplined, you journal your trades, you know what you're doing right, you know what you're doing wrong, bro, this is going to make it so much easier. This is literally the fucking game changer, bro.
You can pair a new habit with a specific.
Now, at the end of the week, you want to be looking for patterns. Like, where am I leaking money? Is there a specific setup condition that I keep ignoring? Is my stop loss tight? Am I exiting too early? Or what's working? Which days, which conditions give you the best results? We want more of those. We want to double down and keep doing that. Then ask yourself, am I following my rules? If you have a loss on a trade when not all of the check boxes were checked, that's a discipline loss, not a strategy loss. And that means you took a trade you shouldn't have. Now, when are you ready to go live? Here's the question everyone wants answered. When do I stop paper trading and start the real thing? My rule, like I said earlier before, you want to be profitable for at least a month. In that month, you want a positive, profitable P&L. You want a journal that shows you follow the checklist on every single trade. And then 3, you can articulate exactly why you took every single trade. If all these are true, you're ready. Go take your first evaluations. Big leagues are that way. Even if one is not true, spend another week in paper trading. Make sure you're refined and you're perfect. I know you want to start making real money, but 1 week of paper trading now can save you the cost of an evaluation and the psychology damage that comes with it. And if you're able to discipline yourself and actually just keep yourself to paper trading, bro, you're going to be a much better trader if you can actually hold yourself and be like, damn, I need to paper trade longer before I do this. I don't want to fuck up anything. I want to be a goated trader. Now, I'm going to show you something that took me way too long to accept. It's not the markets, bro. It's you. Can you realize that? Shit will start pulling up, bro. As you guys can see in that video, the strategy is the easy part. It's you versus you. It's not you versus the markets, bro. The markets is doing what the markets do. It's you. Your decisions, bro. Your recklessness. Your emotions, dude. Once you realize that shit, you'll get that shit, bro. Shit will be coming so much easier. What most people don't know is strategy is only 10% of trading, and your psychology is actually 90% of trading. Because the strategy is proven, the strategy has a win rate, a good win rate, has a good risk reward, but you, when it comes to executing the strategy, when it comes to not overtrading, when it comes to not crashing out over a single loss, when it comes to, oh, this trade might play out, I feel like it's going to play out, when it comes to all of that, your psychology, all that stuff, bro, you are the problem, not the strategy. And it took me way too long to actually realize that. But once I realized that, you guys can literally see when it clicked for me. And that's when my whole trading, that's when everything clicked for me. When I realized that it was me, not the markets. You know the orb now, you know the 6 steps, you know the checklist. Understanding it, that took you maybe an hour of this video. Executing it while you're in a live trade with the P&L moving up and down, real funds actually in the market, that's where most traders fall apart. Not because they don't know the rules, but because they can't follow them when it costs something. Every mistake that I've made in trading traces back to one of these emotions, fear or greed. Greed shows up as holding winners past your target because you feel like price is going to give you more, and then you get brutally stopped out, and then you get stopped out at break even, or removing your stop loss because you don't want to take a loss, or adding to a losing position because you're so sure you're going to be right, or just taking trades that don't meet your criteria just because you want to make some money. And now fear shows up as taking profits too early because you're afraid price is going to reverse, or skipping valid setups because you just took a loss and you don't want to take another one, or moving your stop loss to break even way too fast because you're afraid of losing. And finally, going way too small on good setups because your confidence is shot. Both of these feel rational in the moment, but that's what makes them dangerous. When greed is running your trading, it doesn't feel like greed, it feels like confidence. Trust me, I know. And when fear is running your trade, it doesn't feel like fear, it feels like prudence. The only defense against both is a rule-based system that you follow regardless, no matter what. The checklist, the risk management rules, and the preset exits. You made those decisions when you were calm, so trust them when you're not. FOMO. This is the #1 way retail traders get destroyed. Here's the scenario. The orb breaks out, you're not watching the trade, you missed the retest, price is now 15 points above the level, moving strong. Now every instinct in your head is saying, get in, you're going to miss this move. Don't! You already missed the setup. Chasing a break that is already extended is one of the highest risk, lowest probability trades you can take. You're entering at the worst possible point, right when the market is about to get exhausted and reverse. The correct response to missing a setup is saying, oh wow, that was a good setup. We missed it, boys. We'll catch the next one. Go to your journal. Well, I wasn't paying attention to the markets today. We had an A+ setup. We retested the orb, had a great entry rejection, and I was a donut, and I wasn't there to take the trade. Period. Point blank. Go on to the next day, catch the trade. Because there's always another setup tomorrow. There's always another day. The market is open 252 days a year. That one trade doesn't mean shit. The traders who last in this business are the ones who understand that not trading is a position. Protecting your capital by sitting out on a bad setup is a profitable decision. Let me be real with you about revenge trading, because I've been there. You take a loss, it was a clean setup that just didn't work, and now you're down $300. And immediately before you even process it, you're already looking at the next trade to make it back. Your reasoning feels clear. Oh, the market owes me. I need to make this money before I stop. One more trade, it'll work. It doesn't. It almost never does. Because you're not trading the market anymore. You're trading your emotions. And the market doesn't know you're frustrated, and it doesn't care. It doesn't care that you need to pay rent. It doesn't care that you're homeless. It doesn't care that you need to pay your car payment. It doesn't care if your mom needs money. It doesn't care about nothing. The 2-loss rule exists specifically to protect you from revenge trading. Once you hit the 2-loss limit, the decision is already made for you. You're done. No decisions left to make. No way to let revenge trading take hold of you. And if you find yourself thinking about taking a trade after 2 losses, that's the signal to close a platform immediately. Not in 10 minutes, right now. Walk away. Walk away from the screen, go to the gym, go outside, do anything except look at the charts for the rest of the day. There's a specific psychological challenge that comes with trading a funded account that nobody talks about. When you're paper trading, a loss doesn't sting. But when you're trading on a funded account, you hit that daily loss limit, the account closes, and if your daily loss limit was 1,500, you took 6 trades if you had good risk management and were only risking $250 a trade. That pressure is real, and it will expose every psychological weakness that you have. Here's how I prepare for it. Before the evaluation, I write down my rules, print them out. What I used to do is put all my rules on my monitor with sticky notes, and I will look at them and ask myself these series of questions before I take every single trade. Am I entering this trade off of emotions? Am I getting FOMO? Does my take profit and stop loss make sense? Do they follow the strategy? Am I following the strategy? There was a lot of sticky notes that I had on my computer, and I had to ask myself this question every single time I took a trade, and it changed my trading. Now I know I built that discipline now, so where I can just go in the markets and know what I'm doing right and what I'm doing wrong and what not to do. Now, during a losing streak, if you've lost 3 out of 5 days, I want you to be a little bit more conservative on your risk. Don't risk as much. If you're risking 1%, I want you to drop it down to 0.5%. This reduced size is going to give you some emotional breathing room while you recalibrate. And after a failed evaluation, take 2 days off. Don't get right back into it. Give yourself time to review your journal, identify what you did wrong, and then fix it. Because if you don't know what you did wrong and you go and buy an evaluation, you're just going to do the same exact thing. The traders I see pass an evaluation the fastest are not the ones with the best strategies. They're the ones with the best routine and the best emotional discipline. Alright, you made it through the entire course, bro. Congratulations. And I know what happens to most people at the end of a course like this. They feel motivated in the moment, but life gets in the way. 3 weeks later, they still haven't started yet. And I'm not gonna let that happen to you, bro. Here's your exact 7-day plan. Follow this exactly. No shortcuts. No excuses. Now, day 1, if you haven't done this already, all I want you to do is open up TradingView, get your charts set up exactly how I taught you guys. Get your time frames, get the toolbar set up, get the chart set up, get all the indicators off, get the candlesticks right, and make sure you're on ES futures or MES. And then all I want you to do is activate the paper trading account. Make sure you know the ins and outs, make sure you know how to enter a trade, and make sure you know how to set your stop loss and take profit. And then I want you to find a notebook or maybe make a spreadsheet or a Notion just so you can get your journals, whatever is best for you to journal. You know, screenshot a trade, throw it in a Google Doc, type out your thoughts, journal, however you want. Just make sure you're journaling all your trades. And then that's it. That's all you're doing for day one, bro. Set all that stuff up and then wait for day two. It's very simple, bro. Not overwhelming at all. Now for day two, I want you to open up the 4-hour chart, go to the 1-hour chart. I just want you guys to practice market structure, you know, mark your highs, mark your lows. I want you guys to find a clear uptrend. I want you guys to find a clear downtrend. I want you guys to find a consolidating market that is undecisive and very choppy. I want you to mark all your higher highs, all your lower lows, do everything I taught you in the market structure section. We're not trading today, we're just building an eye for market structure and how to figure out if we are bullish, if we are bearish, and where the market is trending. That's it for day two. Now day three, we're going to be practicing our key levels. For this day, I just want you to go to about 9:30 a.m. and I want you to practice marking out your liquidity levels. Mark those previous session highs, mark those previous session lows, mark those buy side liquidity levels and sell side liquidity levels. And I want you to be able to identify if they're untested or if they're tested levels and make sure they're valid. And I want you to repeat this on 5 different days and just watch how price reacts off of these levels. At the end of this day, you should be able to look at a chart and be able to identify 3 to 5 key levels without overthinking it. Now day 4, I want you to find 5 historical orb setups using the TradingView replay tool. I want you to scroll back 2 months, start the replay at about 9 a.m. EST or whatever time zone you're in. Watch the opening range form, mark the high, mark the low, then mark your key levels, form your bias, and then I want you to find your bias, and then I want you to use that 6-step rule that I taught you earlier. Are we in the direction of our orb? Did we have a good retracement? Did we have a good rejection? Do we have a good entry? Do we have a good stop loss? Do we have a good target? Are we entering off of emotions? Are we entering off of just purely strategy? Are we entering off of FOMO? Are we entering off of greed? You want to make sure you are entering strictly off of your strategy and off of the checklist. Now repeat this for 5 different days. And remember, you don't have to trade every single day. If the setup is not clean, do not take it. If you're arranging, do not take it. If the rejection is not good, do not take it. Don't force yourself to take a trade because that's only going to end badly. Now, by the 5th example, you should automatically know how to see if a setup is forming. Now, day 5 is going to be your first paper trade. I want you to be on the charts at 9 a.m. EST, 30 minutes before the market opens. I want you to complete your pre-market routine. I want you to form your bias, look at the 1 hour, look at the 4 hour. Is a 15-minute, what's the 15-minute doing? And I want you to watch the opening range form, and if a setup appears that meets all 6 conditions, we take the trade. If no valid setup appears, that's perfectly fine. We just mark it in our journal, no clean trade today, and we move on. Now, one important thing, don't be disappointed if you don't find a good setup that day. One of the most important skills in trading is sitting on your hands when we don't have a setup and protecting your capital and your psychology. That's a win, not a loss. Now, day 6, we're going to review and adjust. Your job for today is just reviewing your journal for the week. Look at every entry from day 4 and 5. Ask yourself, did each trade you take pass the 6 checklist evaluation? If you entered a paper trade, what happened? Did we win? Did we lose? If we sat out, was it the right call? Why did you sit out? Identify one thing you're confident about and identify one thing that you're not and that you need to work on. And then just write down 3 rules that you're going to commit to get better next week. Now, this review process is what turns experience into improvement. And without it, you're just repeating the same session with no growth. Now, day 7, live session and setups. I want you to watch 1 live session without executing any trades. Show up at 9 a.m., complete your pre-market routine, find your bias, watch market open, watch the opening range form, mark the orb, watch the setup form, and I want you to narrate this out loud. You can be like, the breakout is happening, now I'm just waiting for a clean retest. The retest just occurred, now I'm looking for a rejection. We have some good rejection, a good entry, but don't take the trade, just narrate it. And then after the session, I want you to write down everything that you noticed. This is a mental dry run, and it builds the habit of a patient observation and of a methodical execution without the emotion of actually taking the trade. If you complete this week exactly how I outlined it, you will learn more about trading in this 1 week than some people who have been learning trading by just watching videos for years. Because you didn't just consume content, you practiced, you learned skills, and you went hands-on. And now from here, the path is clear. Weeks 2 and 3, continue paper live trading every single morning, continue journaling every single trade, and review your journal weekly. Week 4, if your paper trading skills are profitable and consistent, and your journal is also consistent and you're following your rules, you can take your first evaluation. You can go ahead to the big leagues. Weeks 5 through 8, execute your evaluation, follow the rules, and then pass it. And when you're paper trading, make sure you're subconsciously following the evaluation rules. So when you come into taking the evaluation, you're not restricted and you know what you're doing, you're already used to it. And by month 3, you'll have your first funded account and you'll be taking your first payouts. That's the path. It's not complicated. It just requires showing up every single day and executing the plan. Alright, bro. That's the end of the course. That's the complete course. That's everything I know. That's everything that took me years to learn, and I just put it all in this one video for you. The strategy, the tools, the risk management, the psychology, the prop firms, the practice plan. If you apply everything in this video, you have a real shot, everything you need to be a funded trader. But I want to be honest with you about something. Watching this video and executing under pressure are two different worlds. Trust me, I know. I've taught hundreds of students, but the ones who go from 0 to their first prop firm payout in 60 to 90 days are almost never the ones who try to figure it out on their own. They're the ones who had someone in their corner. Someone who can look at their specific chart and say, this setup, don't take it, and here's why. Someone who can review their journal and say, you're entering too early, you keep missing the retest. Stop and wait for the rejection and confirmation. Stop trying to force a trade. We don't trade on choppy days. Someone who's made every single mistake already and can help you skip the ones that cost the real money. And that's what I do in my one-on-one mentorship. I work with a limited number of one-on-one students, and here's what that looks like. We start with a full strategy session. I learn your current level, your schedule, your account situation, and then we build a specific trading plan just for you. From there, we work through the org strategy together until execution is automatic. I review your trades, I tell you exactly where your leaks are, and then we fix them. We target your first funded account together, and if you don't get a payout within 12 months, then I give you a full refund, no questions asked. But I don't take on everyone. I need to know that you're serious and you're actually willing to put the work in. But if you are, I've never actually had a committed student who didn't get funded. And I also do live trading, so if you do want to check in and come on my lives, my Discord is down below. It is for VIP students, but I do have a 7-day free trial. So if you don't like it, you can always just cancel and you will not be charged at all. And if you're ready to start trading with your first funded account, I have dropped the links to Apex, Lucid, and Alpha in the description, and you can use code CWilly at checkout to get you guys a good discount. Look, I made this video because I know what it's like to want this, but have no idea where to start. I was you. I spent years trying to figure this out the hard way. Because I'm be real, nobody on here was willing to just give you all the information straight up. You always feel like they're selling you something, or they're gatekeeping that one thing, or everything just doesn't add up and they're just missing that one thing. Nobody just wants to just give it all to you. So this is me giving it to you straight. The strategy is real, the path is clear, the opportunity through these prop firms is the most accessible it's ever been, and all that's left is you deciding to actually do it. Not tomorrow, not when the markets settle down, not when your schedule clears up. Now, today. Set up TradingView, open the charts, and start watching, bro. You're already ahead of the version of you that was sitting there 2 hours ago wondering if this was worth even learning. Because I'm gonna be real, a lot of people are gonna see 3, 6 hours, 4-hour long video and they're gonna be like, I'm not watching this. I gotta watch this whole video to learn how to trade? No, I'm good. Trust me, that's how most people are. I remember I would try to put my friends on, send them a video. Damn, 6 hours, bro? Do I really have to watch this? They never watch it, and that's how you know that they're not actually built for this. And if this video helped you, bro, just drop a comment. Tell me where you're at in your journey. Tell me what you're working toward. I'm gonna read every single comment and I'm gonna make sure I respond and do what I can for you. Like the video if it was valuable, subscribe if you want more. I post live trading sessions and strategy breakdowns pretty often on this page. And if you want more content, go ahead and follow me on CWilly on Instagram.